Okay. Good morning, students. So, we commence our Sunday with a discussion once again on financial instruments. Uh, I hope yesterday's class was a little uh, productive. I mean, you could feel it productive. Okay. It extended a little bit. We could do one question, and I got the feedback that Excel is not suitable to the understanding. It took a pretty long time as well. So today I will, as usual, be continuing the questions on the iPad. Okay. So the class will be a little longer today. Okay. So be prepared. And we start our discussion on financial instruments. Okay, so far we have seen the definitions, we have seen the accounting, also the classification of your financial assets, as well as the accounting that you have, the treatment of transaction costs. All these we have reviewed. Okay, and yesterday we did just one question. Before we continue yesterday's set of questions, I am having some other concepts to discuss with you, particularly about the effective interest rate. What do you mean by that? And what do you mean? We will discuss a lot today on the amortized cost method. And once that is done, I think we'll solve a lot of questions today so that you can get a grip on the amortized cost method, okay, which is a favorite of the examiners. Okay, so I have just drawn one question for us. Okay, I hope that you can help me solve this question. Okay, we have this particular details, with these details which are given to us. We have an instrument with an issue price of 88,628. Face value is 1 lakh. Redemption is also at 1 lakh. So redemption is happening at par. Okay. Coupon rate is 7%, and the term for which this instrument is there is for a period of 5 years. Okay. So now just help me quickly. You remember how you used to do this accounting, right? So I am having issue price 88,628. That means I have purchased this instrument. Okay, I am the investor. I have purchased this instrument at 88,628. So quickly tell me, this is your extra question. Okay, extra question 1. Okay. So now when you purchase the instrument year 0, what is the entry you would normally pass? Well, the entry that I would pass is investment in bonds account debit 88,628 to bank 88,628. Do you agree with this? Yes. Do you agree with this? Everyone agrees? Sir, this is what AS 13 taught us. The amount paid will be the cost price. So issue price is 88,628. So I have purchased it at 88,628. Then they have given that face value is 1 lakh. Coupon rate is 7%. Coupon rate is nothing but your interest rate. So in AS 13, what you used to do was, you used to apply the coupon rate of 7% on the investment face value. So 1 lakh into 7% would give you 7,000 rupees per annum. So if you remember years 1 to 5, you would pass this entry, bank account debit to interest on bonds. How much is that? Well, that is 7,000. Okay, so this is coupon received. And in year 5, the bond is getting redeemed at 1 lakh. The bond is getting redeemed at 1 lakh. So the entry that would be passed is bank account debit. I get 1 lakh to investment in bonds. That comes to 88,628. And finally, I am having a gain on redemption. Can somebody help me with the gain on redemption? Yes. How much is the gain on redemption? How much is the gain on redemption? That comes to 11,372. Okay. So this was the set of entries that AS 13 prescribed us to do. Do you agree with this or not? That is the first point. You will have to tell me. Do you agree with this? Yes, Janvi, Kaushiki, Namrata, Tushar, Viraj. Do you agree with this? Yes. This was what we used to do. Yes. Bolo yaar. Yes. All right. Now let me slightly modify. Where did I write this answer? Why did I write it here? Okay. I should not have written it here. Okay. Okay. I'll just quickly write it here so that year 0, investment in bonds debit to bank 88,628. Okay. 88,628. Year 1 to 5, bank account debit to interest income 7,000. Year 5 is your redemption. So bank account debit 1 lakh to investment in bonds 88,628 to gain on redemption. This is 11,372. Okay. So this was the entries that you used to pass. Now let me just modify the questions facts a little bit. Let me just modify the facts a little bit. Let us assume that this is a zero coupon bond. Let us assume that this is a zero coupon bond. So what is a zero coupon bond? Sir, a zero coupon bond is one that is not giving any interest during the life of the bond, and you get the interest directly at the time of redemption. Okay, so you give a very low discount, you give a very high discount, low issue price, and the discount is compensated by giving a par redemption or a redemption with premium. So therefore, let us assume that the issue price, I'm just modifying the facts here. Issue price is rupees 62,092. Okay, this is the issue price. Interest equal to 0. Okay, and then we are having redemption 1 lakh at par. Okay, so this is the scheme that is there. You subscribe to that scheme. AS 13 के हिसाब से what is the entry that I will pass? Year 0 when I invest in the bond. Investment in zero coupon bond debit 62,092 to bank 62,092. Years 1 to 5. Will you receive any interest? Answer is no, I'll not receive. Why you will not receive? Sir, will not receive the interest because it is a zero coupon bond. The coupon rate is 0%. So therefore, no entry. And then in year 5, the entry that will be passed is for the redemption, bank account debit. Well, as per the terms, you get 1 lakh to investment in zero coupon bonds 62,092 to gain on redemption. So that comes to how much? That comes to 37,908. So this was the accounting that was prescribed under AS 13. Okay. A simple accounting where you followed the legal form of the contract. You would look at the contract for the subscription. You would look at the interest coupon rate. You would look at the redemption value. You would look at what you can say, any premium or a discount is there, any zero coupon facts are there. And once that is there, you would do the accounting accordingly. However, tell me one thing, there is a flaw in this. Okay. There is a flaw in this accounting. Let me ask you with the help of zero coupon bond first. Okay. Then you can move to the other bond that we discussed initially. Tell me, 62,092 is redeemed at 1 lakh. Okay. So now, do you think that 37,908 is that the entire gain on redemption? Or in fact, it is the accumulated interests over a period of 5 years, which you have not paid, which you are now paying at the time of redemption? What do you think? In a zero coupon bond, I have paid a premium of 38,000 roughly on an investment of 62,000. I have received that. I am the investor. I have received a premium of 38 on an investment of 62. So do you think this is really premium on redemption? Or do you think that this is in fact interest which is getting deferred over a period of 5 years? Yes. So answer is, everybody is saying that yes, it is accumulated interest that is getting deferred for 5 years, because as per the contract, there is no payment of interest that is happening. And because of that, Accounting Standard 13 does a legal accounting in accordance with the contract, and the contract does not prescribe payment of interest annually. So therefore, there is zero interest, and ultimately you are getting 37,908 on redemption. Okay. So that is the major flaw that is there. Okay. If you give this to the reader of financial statements, year 0, he will see that you have invested 62,000. Year 1, no return. Year 2, no return. Year 3, no return. Year 4, no return. Do you think any investor is going to sit patient like this? There will be questions thrown at the management. You have invested in something, but it's not giving any return. If at all you had to do that with our money, why would I give the money to you? I might as well put it in your fixed deposit and get a guaranteed rate of return. You have invested something and you are not booking the interest. That means you are not recording any interest income. That means nuksan to hamara ho gaya na as investors. So that is the first question that will come out. The next question that will come out is, in year 5, suppose an investor buys the shares and he notices that there is a bond for 62,000 and the gain on redemption is 38,000, which gave a phenomenal return of about roughly more than 50%. Okay, it comes to about 60%. So you will then start telling the earlier bond gave a 60% return roughly, whereas you so therefore in future all your investments must give a 60%. Is that argument making sense? For the investors, it does, because that is the way the financials are presented. That means there is an inherent flaw in the way we do the accounting. Okay. So therefore, till now, the accounting was done based on the coupon interest. Okay. Coupon interest is basically the interest which is mentioned in the contract. In which contract? The debenture subscription contract, bond subscription contract, etc. So we used to believe that that is the interest figure, and therefore we would do the accounting based on that, which is not actually correct. Okay. Now you will be able to better appreciate the first case. Okay, the unmodified case. See, you have invested in bonds 88,628. Now you have, this is the amount which you have invested, 88,628. However, the interest that is determined is 7,000 on 1 lakh. So therefore, if you do 7,000 by 88,628, how much does that come to? 7,000 by 88,628, that comes to about 7.9%. That comes to 7.9%. But sir, my interest is only 7%. No, हाँ, but वो किसके ऊपर है? Sir, that is at 7% on the face value. ये face value नहीं है. This is not your face value. This is the amount that you have invested. Now you tell me, honestly, interest on investments made, interest on investments made, pure logic as an investor, do you think that the return on investment should be calculated based on a face value, or should the interest or return on investment be calculated on the amount that is actually invested? You got my question? Should I record the return on the face value, which is not the invested amount, or should I record the return on investment on the invested amount and not the face value? What do you guys think? What do you guys think? You will have to record it on the amount invested. The very same principle which we used here is also getting failed here as well. Okay, so this was the inherent flaw that standard setters noticed in the erstwhile accounting standard 13 and similar accounting principles that were followed globally as well. Okay, so as a result, the standard setters sat down and they decided that we will have to come to an agreement that this is not fair accounting. Okay, this is not fair accounting. I'm not saying this is not fair value. Okay, fair value tak abhi tak hum pahunche nahi hai. Okay, it is quite possible that you have such a scenario and still your instrument is at fair value. Okay, fair value is different, amortized cost accounting is different. Okay, for fair value, what is necessary is your rate should be matching with the market interest rate. That's about it. Okay, then you are at par with the market. You don't have any off market element. Now, what the standard setters felt is, ये नहीं चलेगा. This is not going to work. So therefore, आपको क्या करना पड़ेगा? You will have to find out what is the actual return that you are getting on the investment. So let us come back to our example 1. Let us come back to example 1. On 88,628. What is this 88,628? Sir, this 88,628 is the amount I am investing today. So can I call this as present value of cash outflow? Answer is yes. Now, in inflows, in your cash inflows, what is it that you are earning? What is it that you are getting? Sir, I am getting 7,000 per month as inflow. Okay, 7,000 per month as inflow multiplied by, or not 7,000 multiplied by. Okay, I will first say what I am getting. Plus, I'm also going to get the principal. I'm also going to get the principal after 5 years. So the principal amount that I'm going to receive is how much? The principal amount is 1 lakh. The principal amount is 1 lakh. Is it okay? Yes. So therefore, we have to find out a particular rate that equates the present value of cash outflow with the present value of cash inflow. That is the rate. That rate is going to be the rate which you are earning on your investments. Do you remember something known as IRR? Yes. Do you know something known as IRR, internal rate of return? अरे मालूम है क्या अपने को? Internal rate of return. What is it? What is internal rate of return? For a capital budgeting project, the internal rate of return is that return which equates the present value of cash outflow with the present value of cash inflow. If you are generating your internal rate of return, or if you have put projects at the internal rate of return, then the PV of cash outflow is equal to the PV of cash inflow. Okay, PV of cash outflow is equal to PV of cash inflow. So I have to find out a particular rate that equates these two components, that is 88,628 as well as 1,000 per month plus 1 lakh at the end of the redemption period. Okay, sorry, not 1,000, 7,000 per month, 7,000 per month. Okay, so this is what I will have to equate. And how do I equate? Well, the answer is typically a trial and error method. The answer is typically a trial and error method. Okay, so I have already done the working for you. Okay, I have already done the working. We do not need to check that working. Effective interest rate in this particular case comes to 10% because every year I am getting 7,000 coupon rates, and in the last year 1 lakh principal and 7,000 coupons. So total comes to 1 lakh 7,000 discounted at 10% gives you present value of cash outflow of 88,628. So this is my issue price, amount invested. This is my present value of cash outflow. Both are equal. That means the bond is giving me a 10% return. The bond is giving me a 10% return. Have you understood so far? Yes or no? Have you understood so far? Did you follow so far? Yes. Now let us move further. So your debenture which you have invested, or the bond which you have invested in, is not giving you a 7% return. The bond which you have invested in is in fact giving you a 10% return. Are you getting my point? You are getting a 10% return. So what is that 7%? 7% is a mere coupon, yaar. It is just returning the money back to you in tranches. Okay, so they are not going in for a clear what you can say, they are going to settle you at 7%. That 7% has nothing to do with your interest rate. See, are these two equal? Answer is yes. Because these two are equal, the issue price and the PV of cash outflow, since they both are equal, therefore IRR equals 10%. IRR equals 10% means what? The bond in which you have invested is actually giving you a 10% return. Got my point? The bond in which you have invested is actually giving you a 10% return, a 10% return. Then sir, what is this 7%? 7% is merely a repayment that is made to you each year. Okay, instead of going for an entire lump sum payment at the end, they have said that you do a minimum repayment of 7% each year. But that 7% is not going to be an item that hits the profit and loss account anymore. The 7% is mere repayment of the liability. Then sir, which rate starts to hit the P&L? Sir, it is this rate, that is the 10% rate, that starts to hit the P&L. Is it okay? Did you guys understand? Yes or no? Bolo? Have you understood this part? Namrata, did you follow? You are earning 10% because your invested price is 88,000. You cannot say that 1 lakh is the invested amount because आपने उतना invest किया ही नहीं है. At the same time, you cannot say that 7,000 at 7% of 1 lakh is my earning because you have not because I had not invested 1 lakh at the beginning. I had invested whatever be the figure, okay, but certainly not 1 lakh. Okay, so this is the first thing. Second thing, coupon rate. Mere repayment rate, it has nothing to do with what you have earned, because it is dependent on a value which you have not invested in the first place. It is dependent on a value which you have not invested in the first place, meaning you have depended on 1 lakh to calculate 7,000, but 1 lakh is not invested in the first place, and therefore 7% stands to lose any relevance. Okay, so all these things which we used to do under AS 13 are no longer required to be done. So therefore, what is the accounting entry? What is the account calculations? How will the calculations flow? Okay, so the calculations flow something like this. Year 1, your opening balance is 88,628. Everybody agrees to this? Yes, everybody agrees to this. Effective interest rate 10%. So therefore that comes to 10% of opening. So that is 8,863. That is 8,863. However, the coupon rate is at 7,000. That is basically a repayment of this. Basically a repayment. So you're not making any principal payment right now. The principal is paid towards the end, and therefore your closing figure is 90,490. And इसी figure को we also call it as amortized cost. We call this figure also as amortized cost. Did you understand the first year workings? Did you understand the first year workings? Yes, have you guys been able to get the first year workings cleared? Got it. Okay. What about the others? Namrata, Kaushiki, Jahnavi, Viraj. See, get your total attention on what we are going to do today. Okay. First year working is clear. Okay. Viraj has confirmed. Others, I hope it is clear. So now, what is the scheme of entries that you are going to pass? What is the scheme of entries you are going to pass? I'll just write here for your reference. Okay. I'll just write here for your reference. Year 0. This is the investment you are making. So investment in bonds, debit to bank. $88,628. This is the first investment made. Then you move on to the next part. You then move on to the next part. Years 1 to 5. Years 1 to 5. Okay. To interest income. Viraj, I'll come to your question better. That is there as a part of the examples. Okay. So I will come to that. We can discuss that. Okay. To interest income. Well, year 1, 2, 3, 4, 5. Okay. So years 1, 2, 3, 4, and 5, you are having interest income of 8863, 9049, then 9254, 9479, and lastly 9727. Okay. 9727. Hi Shubham, good morning. Okay, all right. So now, what am I going to debit? What am I going to debit? सर बैंक अकाउंट डेबिट करते हैं ना इंटरेस्ट इनकम में, कैन यू डेबिट द बैंक अकाउंट? बोलो यार, कैन यू डेबिट द बैंक अकाउंट फॉर दिस इंटरेस्ट इनकम? कैन यू डेबिट द बैंक? आई एम आस्किंग यू स्टेप बाय स्टेप so that the concepts you go on understanding. We cannot debit the bank account because इतना पैसा आया नहीं है. पैसा कितना आया? पैसा आया है 7,000 per month. This much has not come. So this is interest accrued. And interest accrued, where does it go? It goes and sits in the investment in bonds. So therefore, as Kaushiki rightly said, we are going to debit investment in bonds. So this comes to 8863 9049 9254 9479 9727. This is the bond accrual of interest. It goes and sits in the bond. वो जाके bond में बैठ जाता है. Okay. All right. Now every year I am receiving 7,000. Every year I am receiving 7,000. Okay. So this 7,000 which I receive, what you type it here only, Shubham. Okay, you type your queries here only. I get the access. So whatever doubts you have, you can ask here only. Okay. So now you are receiving 7,000 every year. So first thing is bank account debit 7,000 each year. Yes. What am I going to credit? What am I going to credit? Sir, I will credit interest income. No, you cannot. ये आपका interest income नहीं है. You have already booked the interest income as 8863, 9049, 9250, blah, blah, blah. However, you are receiving 7,000. It is not tantamounting to interest. This is nothing but return of your investment in parts. Okay, this is nothing but return of your investment in parts. So years 1 to 5, you will pass the entry bank account debit to investment in bonds. 7,000 is coming back. 7,000 is coming back. Is it okay? Is it okay? What are your doubts? You can ask Shubham. Let us see. Is it related to this chapter or is it related to some other chapter? Somebody else taught. I only taught. Please let me know. Okay. Doubt solving. We can have it. Okay. All right. Is it clear, everyone? Yes. Is it clear? Any doubts? No doubts? Kaushiki, Namrata, Viraj, Tushar. Janvi. Is it clear? All right. So now coming to the next part. If I do all this, year 1, year 0, 88,628, year 1, 8863, return 7,000, accrue 9049, reduce 7,000, accrue 9250, reduce 7,000. If I go on doing this for 5 years, at the end of the 5th year, how much will be the closing balance? That will come to 1 lakh. That will come to 1 lakh. So now you can see 10%, this is 10%, this is 10%, 10%, 10%, and this is also 10%. So every year I earn 10%. I get a repayment of 7,000 per annum. So therefore the closing balance at the end of the tenure is going to be the face value of the bond. That is 1 lakh. So therefore, how do I pass the entry here? How do I pass the entry here? In the end, you are getting the full money. So bank account debit to investment in bonds. 1 lakh. Okay. So this is the final entry that you will have. And then will there be any gain on redemption? No. Sir, why there won't be gain on redemption? Array, look at your term, look at your agreement. Face value 1 lakh, redemption 1 lakh. Where is the redemption premium? Yes, it won't be there. Okay. Even if it is there, you will not have a single redemption premium appearing at the end. You will not have a single redemption premium appearing at the end. Is it okay? Yes. Any doubt so far? No doubts? No doubts? All clear, everyone? I'll come to your query, Shubham. It's a very specific query. Yes, everybody clear? No premium on redemption, nothing will appear at the end. Bond investment grows to 1 lakh and then you get the refund, or what you call the maturity proceeds, 1 lakh. Okay. So that takes care of the bond life. Okay. Now, the last concept. See, the bond ultimately grows 90,490 end of year 1, 92,539 end of year 2, 94,793 end of year 3, 97,273 end of year 4. Ultimately, the bond amortizes and becomes 1 lakh by the time it is ready for redemption. So the moment you record the interest, record the coupon, record the interest, record the coupon. Every year go on doing this. The ledger balance in the bond, the ledger balance in the investment in bonds account goes on increasing from 88,628. It ultimately becomes 1 lakh. It ultimately becomes 1 lakh. And then you do a redemption entry. Did 88,628 become 1 lakh in a sudden 1 year? No. Did it become 7,000 each year and in the last year 11,372? Answer to that is again no. That is also not right. It ultimately gradually built up over the period by earning about 10% effectively. By earning about 10% effectively. So in the last year, the bond GL balance already appears at 1 lakh. And this bond GL balance is ultimately what you are going to recover at the maturity of the bond. So once the bond matures, you submit the bond documents to the company and the company is going to pay you 1 lakh rupees. What entry the company will pass? Well, the company receiving the redemption amount will pass bank account debit to what? To investment in bond. 1 lakh rupees. It's done. Okay, it is done. So that is how the accounting of the bond is going to happen. Are you clear with this, everyone? Yes? Tushar, did you follow? Okay. Tushar, all clear? He had a doubt in the last concept. Okay. All right, fine. So now this is how the accounting will happen. Just for our, just to indulge you. Okay, just to indulge you and show you something that you already will know probably. The interest under AS that was recognized is 35,000. 7,000 each year for 5 years. And the gain on redemption that was booked is 11,372. 35,000 interest, 11,372 gain on redemption. Under Ind AS, instrument वही है. So therefore, you are earning total interest of 46,372, which is nothing but 35,000 coupon plus 11,372 gain on redemption. You can check it for yourself. 46,372 is nothing but the sum of the earnings under the AS plus the gain on redemption under AS. Okay, it will be exactly the same. Okay, so that is how you would do the accounting. Is it okay? Yes, are we clear? Any doubts? Anybody has any doubts about this? Particularly what goes in the P&L, is that clear? We have done a comparison. Basically under AS also over the 5-year tenure same amount went. Here also over the tenure same amount went. But ultimately it is the presentation that matters. Clear. Okay. So what I want you guys to do is, have you written this down somewhere or do you want to write it down? Have you written this down or do you want to write it down? Either of the two is okay. If you are writing, I'll just wait for you. Just give me a minute. Okay. Okay. Please make a note of this. Of course, I'll share this with you. But if you write it down, that is also fine. Or if you just take a screenshot, that is also fine. Okay. Okay. I'll wait for a couple of minutes until all of you confirm. Okay. So now Shubham's question, how to prepare for GFRS? Well, preparation for a paper like GFRS will require you to have an understanding of how exactly you need to IFRS works. Okay, so my advice is, if you are selecting GFRS, nothing like that, it's one of the best papers out there. Okay, so in fact I pursued ACCA solely for the purpose of getting knowledge about IFRS. Okay, so I qualified my ACCA. I found it very interesting and therefore I picked up I started up with diploma in IFRS offered by ACCA, and I was so much in love with this particular topic, these standards, that I said, chalo, let me pick up ACCA for the sake of preparation, for the sake of studying. So I forfeited my exemption. See, as chartered accountant members, you get exemptions from ACCA papers. I forfeited those exemptions because I wanted to go through the way the answers are presented, the way the curriculum is designed. It was a real fun in just studying, and I could study what you can say, the IFRS in a very detailed manner. It's a very different approach out there in the way ACCA sets its papers. So I believe that GFRS is on similar lines. Okay, so if you want to go through GFRS paper, my advice is you can start picking up resources that are available on the net. Okay, the ACCA global website is one of the starting points where you can pick up the IFRS content. You can also look at the content like you have certain private parties like Becker's Learning or Kaplan or whatever is there, just to get a feel and understanding of how the questions are. They are very beautiful questions. Okay, so you can pick it up. As far as I understand, the GFRS paper is an open book one, so that allows you to take your materials content into the exam hall. But more than the fact that it is an open book, it is an application based examination, and therefore I want you to be it is impossible that you can study all the questions from your study mat. There is no study mat in the first place for the GFRS paper. So you can always expect a new question, a new thought, a new idea coming into the exam. So the first thing is get your Ind AS base absolutely clear, the concepts. Then you move on to looking at case studies under IFRS. You should be thorough with the carve-ins and carve-outs. Okay. We have done the carve-ins, carve-outs here as well. So therefore, the carve-in, carve-outs are extremely important. You can use your Ind AS concepts plus the carve-ins, carve-outs to get what is there in the IFRS. Okay. And since Ind AS and IFRS is almost 90% on similar lines, in fact, the standards are verbatim incorporated in India. So therefore, you will not have much of a difficulty. But the papers you can expect to be of a standard that is comparable to ACCA or those foreign examinations. Application oriented, it will not be a simple question solving that the way we are doing it here. So therefore, be strong in your fundamentals. Okay, that is the main thing that you will have to ensure. Okay. Look at resources, you have certain private content, look at the past papers to get an understanding of how the questions come in the examination. Okay, so that is as far as Ind AS and IFRS, your GFRS paper is concerned. Okay, the same goes for US GAAP also. Okay, US GAAP also you want to study. I personally am not much aware about US GAAP. I'm not specialized in that. Okay, but I suppose you have content like the same Beckers and all who are providing content for US CPA, so you can pick it up there. But honestly, there is a lot of difference between the US GAAP as well as the IFRS. Though you have the International Accounting Standards Board meeting, sitting together, getting the things on par, but there is still some major differences between the US GAAP as well as the IFRS. So you will have to ensure that you get a clarity on the gaps as well as the accounting that happens there. Things are quite different under US GAAP for certain aspects. I'm not much aware of that. Okay, but there are. Okay, but there are. It is largely a rule-based approach. Okay, I'll give you the resources at the end. Okay, typically, okay, you can just take a note of it. Okay. It is something like, this is the ACCA resources. Of course, our institute's past questions are also there. So you have something like Kaplan or BPP, okay, or Becker's. Okay, BPP Learning Media, I suppose, and Becker's. Okay, so all of them contain good content. Okay, you will be having the theory on the IFRS discussed in brief, and you will have questions, sums, practice, everything that happens. Okay, so that is what is there in your, what is important for your GFRS paper. Okay, so this is what you can refer. All right, so that takes care of, that is all your query. Okay, so all right, fine. Now let us come back to our questions. Okay, all right. Now, sir, for calculation of amortized cost closing, okay, do I have to add interest for maturity year in the amount? See, it depends. See, I did not include principal. Okay, good question, but it is just a matter of presentation. Okay, what Viraj has asked is, I'll just remove this kalakari that I have done. Okay, what Viraj has asked is, in the maturity amount that is in the last year, the pay in that happens, should I include 1,07,000? Means should I include 1 lakh because that is also returning back? Answer is ideally yes. Answer is ideally yes. Okay, you have to include. But it won't make a difference to me at this stage because what I have done is I am interested in getting the effective interest amount correctly. See, I have prepared this in Excel, and when I prepare this in Excel, I don't have to worry about rounding of errors. I take the complete decimals and fill it up. But when you do it manually in examination, you will obviously round off the discounting factors. Sometimes the question will give you the discounting factors, which are up to 3 decimals or 4 decimals, whatever it is. So therefore, you will be able to calculate the effective interest correctly for the first 4 years. But in the 5th year, when you apply the 10% rate, thoda sa rounding of error will come. There will be a small rounding of error. So in the last year, what approach is generally followed is you fix the amount here, add back, and then get this as a balancing figure. This is the typical approach that institute also follows. It is acceptable because in exam, we are not testing you on how effectively you can punch numbers on the calculator. We are testing you for how well you know the concepts. So a small rounding of error should not affect your marks at any cost. So therefore, we take this as a balancing figure. And for the purposes of balancing figure, we just say that at the end of the life of the bond, it should go up to 1 lakh. And then 1 lakh will be paid off immediately. Alternatively, what you can do is, you can tell that this is 1,07,000 and then do the working. You can tell that this is 1,07,000 and do the working. Okay. Or alternatively, what can you say is you show principal payout separately as 1 lakh. This closing should become 0. Work backwards and you will get the EIR. But what happens again here is if you work backwards, your balancing figure will go very huge. Okay. So therefore, what I do as a practice is I keep 1 lakh as the amortized cost and get the amount as a balancing figure. This is reasonably acceptable. Okay. All right. Now, Namrata has asked a question. We are coming to that only. Okay. We are coming to that, the trial and error method. So just give me some time. Okay. So this is the first part that is done. So am I recognizing the same income what I used to do under accounting standards versus what I do under Ind AS? Answer is yes. Only thing is the manner of calculation differs and the name which you give to the income differs. In AS, there would invariably end up being a gain on redemption at the end. But here it ultimately moves on a gradual phase-wise accounting of interest income with a redemption without any redemption premium. Okay. So that is how you will do the accounting. So this is the first part. Now let us move on to the next one. Okay. All right. Okay. Same question. I'm slightly modifying it. I have a bond with an issue price of 88,628 and transaction cost of 1,372. Don't look at yesterday's notes. Tell me quickly, transaction cost, should it be added to the fair value or should it be added to the fair value? I mean, should it be added to the cost should it be added at the time of initial recognition or should you take it to the P&L? Transaction costs under 3 methods: amortized cost, fair value through other comprehensive income, or under these 2 methods, you will take it to the cost of the bond or recognition of the bond or add it to the financial asset. And in the case of FVTPL, we take the transaction cost to the P&L. We take it to the P&L if it is FVTPL accounting. But here, is it FVTPL accounting? Answer is no. Why no? Because look, is it a financial asset? Yes, I have invested in a bond. By investing in a bond, what are you going to get? You are getting a contractual right to receive cash. So this becomes a financial asset. Now, if it is a financial asset, you will have to check whether it is meeting the SPPI or the CCFC test. Is it meeting the CCFC SPPI test? Answer is yes, because you are holding it only for the purpose of collecting the contractual cash flows in the nature of principal as well as interest. So therefore, the SPPI CCFC test is met. So then you move on to the next test, which is your business model test. And in the business model test, you will have to check whether you're holding this investment up to maturity. Am I holding up to maturity? Yes, I'm collecting the redemption amount as well. And therefore, these investments are held with the objective to collect contractual cash flows and not to sell them. And therefore, which accounting should I follow? Sir, I should follow amortized cost. And because I follow amortized cost accounting, the transaction cost must be added to the fair value at initial recognition. And that is why the fair value at initial recognition plus transaction cost is the value at which you will recognize. So that comes to 90,000 rupees. That comes to 90,000 rupees. Is it okay? You will not take it to P&L. You will take it to P&L if it is FVTPL instrument. But if it is FVOCI and if it is amortized cost, you will add it to the cost of the instrument, the fair value at initial recognition. Acha. Now let us move again. Let us move further. Here, the effective interest rate is not given. Many people ask this effective interest rate, will it be given? Will it be given? Will it be given? So now we have come to that stage where the effective interest rate is not given. Sir, we are given 7%. Na? Something is given to us. That is coupon rate. See, you are investing 90,000. You are investing 90,000. But 7% is not the return on 90,000. 7% is the return on 1 lakh, which you have not invested at all. It is just a coupon rate. So 7% cannot be the return. You will have to calculate the effective interest rate. Without looking at the solution, whatever part is there, which I have now hidden, tell me a simple thing. Will the effective, what you can say, interest rate increase or decrease because of transaction costs? Will the effective interest rate increase or decrease because of transaction costs? Come on. I don't want you to calculate. I just want to apply your mind on a Sunday morning. It is very difficult, especially in summer. But apply your mind. Okay, tell me logically. If transaction cost is added to issue price, what will happen to my effective interest rate? Absolutely right, it will decrease. Obvious सी बात है ना, पहले हम सफर तय कर रहे थे from 88,628 till 1 lakh. तो रेट क्या था भाई? रेट था 10%. Now we are crossing the journey from 90,000 to 1 lakh. So the net return that is there is lower, and therefore the EIR also will drop. EIR also will drop. So this is the first step that you have to understand. Okay, now we move on to the next one. So how do I calculate? Sir, we have to use trial and error method. कोई और option नहीं है. अच्छा, in most of the examination question, you will be given the EIR, the effective interest rate. Rare cases, nahi diya rahega. That time you will have to calculate. Okay. By the by, tell me, is this transaction at fair value? Is this transaction at fair value? Is this transaction at fair value? Bolo. Will the transaction be at fair value? When we do this accounting, the accounting earlier, what I did the first example, the accounting that I did now, have I calculated fair value or was it already at fair value? What do you guys think? Because I saw somebody talking about fair value. Yes, it is at fair value. Don't make a mistake. See, what happens is students get confused when we study further today transactions which are off market. Students will end up getting confused and they will start looking everywhere that अरे यार कौन सा भी transaction fair value पे है ही नहीं. It happens. Okay, you do a couple of questions and everywhere you will start looking at people with suspicion. Transaction is not at fair value. Transaction is not at fair value. That is not the case. See, your coupon rate will never be equal to effective interest rate, because coupon is typically calculated on the face value. Effective interest rate is calculated on the amount invested. So most of the cases, coupon will never be equal to effective interest rate. Coupon will be equal to EIR only if amount invested is equal to the face value, is equal to the duration, is equal to the redemption at par. If all things become equal, then the coupon rate and EIR will become equal. But even if they are unequal, it is possible that the transaction matches the market rate of interest. Your EIR is equal to the market rate of interest. And for determining whether it is fair value, we look at this condition. If effective interest rate and market rates of interest are same, similar, equal, okay, no difference, then it means that the transaction is at market terms. We are doing a fair value accounting, which is exactly what I'm doing here, because here I don't have the market rate of interest information. So I have to come to the conclusion that my EIR itself is the market rate. If they had to give a different, if this is not equal, then we have a problem. If EIR and market rate of interest is not equal, then I'm going to have a problem. Okay, then I'm going to have a problem. But you cannot say that EIR and coupon is not equal, transaction is not at fair value. नहीं, आप ऐसा कतई नहीं बोल सकते. You cannot say that. Okay. For example, a zero coupon bond. Okay, let us take a zero coupon bond. This was 0. EIR is 10%. The zero coupon bond was issued at 62,092 in our question. This 62,092 is issued in the market as well. You cannot compare this and say that the transaction is off market. No. The same zero coupon bond is priced for issue at 62,092 rupees. And therefore, the transaction is at fair value. You cannot say that because EIR is not equal to coupon, transaction is not at fair value. ये comparison होता ही नहीं है for fair valuation. Comparison happens with market rates of interest. Okay, so that is one very common confusion that students have. Okay, so just keep that in mind. Okay, you will understand from the question that transaction is not at market terms. Okay, वो पता चल जाता है. All right. So anyways, you will now have to calculate the EIR. One thing is, will it be 10%? No. Will it be about 10%? No. Will it be below 10%? Yes. So we will have to do a trial and error. So first thing, I will check at the rate of 10%. You can start with anything in your exam. Start at 10%. I got 88,628. But my PV of cash outflows is 90,000. So my PV of cash inflows should be equal to 90,000. Okay. So then you said the EIR should reduce. So we next check at 9%. These are just calculations. Okay. So I don't have to go into large detail of calculating discounting factors and all. Okay. So this comes to 92,221, which is higher than 90,000. So when you have to calculate the effective interest rate, for one trial, it should go above the cash outflow. For another trial, it should go below the cash outflow. So then it falls between that range. So in this case, 9% went above 90, 10% is below 90. So therefore 90 is in between 9 and 10%. Okay. So you can either calculate the PV of cash outflow by preparing this table, Or you can do an annuity calculation. In one line, you will get your answer. Is it okay? Yes. So now, once I got it that it is between 9% and 10%, you will then have to do the extrapolation. So let us assume that my required rate is X. Then how do you do the extrapolation? For X, the cash flow should be 90,000. For 9%, it is already 92,000. 10%, it is 88,628, and 9%, it is 92,221. So when you solve it, you get a rate of 9.62%. Okay. You can do it this way. Agar ye samajh mein nahi aata, you can think it of like this. At 10%, my present value is 88,628. At 9%, it is 92,221. So therefore, for a 1% fall, what is the increase that I am having? Well, the increase that I am having is 88,628 minus 92,221. The increase that I am having is 3,593. The increase, okay, 3,593. Now I have to reach 90,000. There are two ways. I start with 10%, come down. I start with 10%, move this upwards. So ultimately my rate will move downwards. Or I start with 9%, move this downwards, ultimately rate will move upwards. So kahin in between hamara gaadi jaake milne wala. We are going to meet somewhere in the middle. Do you know this extrapolation calculations? Yes. Do you know it? Do you remember it? Yes. So let us check. See, if I start with 10%, from 88,628, I need to reach 90,000. So minus 88,628 minus 90,000. The increase should be 1,372. So therefore, you can then do a proportionate calculation. Okay, you can then do a proportionate calculation. 1372 into 0.01 divided by 3593. So this comes to 0.38%. I just did the cross multiplication. Okay, this comes to 0.38%. It should come down because I started with 10%. So 10% minus 0.38. 10 minus 0.38 comes to 9.62%. Okay. Or you can do the other way also. From 9% at 92,221, you want to grow. You want to what you can say, you want to come down. The rate you want to grow, the cash flows you want to come down by how much? 2,221. So for 1% increase, your 1% decrease, no, this is going to be increase. For 1% increase, the cash flows came down by 3,593. But you want it to come down by only 2,221. So this comes to how much? 2221 into 0.01 divided by 3593. So this comes to 0.62%. So 9% plus 0.62. This gives you 9.62%. You can do it by any of the three methods. I am fine with all of that. Examiner also is fine with all of that. Okay. And this is anyway something that will be given. So let us not take much time in doing this. Okay, so 9.62% is your effective rate of interest. So what you will do is you will then prepare the amortization table. You will then prepare the amortization table. You start with year 1. What is your opening balance? Sir, 88,628. Galat, galat, galat. That is wrong. The opening balance is 90,000 rupees because transaction cost is added to the fair value at initial recognition. So it will be 88,628 plus 1372, that is 90,000. It will be opening balance is 90,000. Interest at 9.62% is 8,656 and 7,000 is the coupon. So therefore amortized cost closing is 91,656. You go on preparing this table. Ultimately at the end of year 5, it ends up getting amortized to a value of 1 lakh, which we will repay immediately. Did you understand the second question? Yes. Did you understand the second question? Yes or no? Yes. All right. Everybody got it. So this is how you will be doing it. Acha, what is the total income that I have recognized? I have recognized 45,000. Sir, how 45,000? Well, it is going to be 35,000 coupons which you were recognizing earlier plus 11372. This is what you had recognized earlier under AS, but now 1372 is no longer recognized. 1372 is no longer recognized because that is your transaction cost. You have income of 46,372, but you have a transaction cost of 1372. Are you able to appreciate? So tell me, friends, ultimately transaction cost, where it is going? Is it going in the balance sheet or ultimately it is flowing to the profit and loss account? Ultimately, it is flowing to the P&L. But in what manner it is flowing to the P&L? In the manner of what you can say over a period of 5 years. It is flowing over a period of 5 years. Are you able to follow? Are you able to kind of understand? Yes. 1,372. Is it only getting capitalized in the financial asset? Answer is no. It is getting transferred to the income over a period of 5 years. आपको दिखता नहीं है. It's not visible. But that is exactly what is happening, which is why I have tried to highlight it here. 1372 is ultimately reducing the total interest that you have recognized. Earlier, you had recognized 46,372. Yaad karo. There was no transaction cost. You had recognized 46,372. But now you are recognizing 45,000. तो कहाँ गया ये 1372? This is exactly what is the transaction cost, which is like an expense against the interest income, and therefore you will credit it to the this is like an expense, and therefore you will you are overall debiting it to the profit and loss account. Is it okay? Yes. Sure. Is everyone clear about transaction cost? Yes. Is everyone clear about transaction cost? कोई डाउट, कोई तकलीफ, कोई मुसीबत, कोई परेशानी? So Namrata, your query is addressed about trial and error. We will have to do that. We have one more question where we have done that. Sir, clear about transaction cost. Okay, so Tushar, I'm not able to get it. Okay, let me know if you have understood. Okay. All right. Kaushiki has confirmed. Janavi, is it clear? Namrata, is it clear? Your query addressed? Bolo. Those of you who want to note this down, can please note this down. Okay. Okay, those of you who want to note this, please note it down. Okay. Okay, Kaushiki has said she has noted. Give me a minute, please. Okay. Sorry, too much of interruptions. Today I'm all alone at home. So we are having, some or the other person keeps coming. Okay, being a Sunday. Okay, some student life is the best life. Somebody is always there to take care. Okay, all right. Transaction cost ka relation. Okay, see, what is transaction cost? Ultimately, I got some answers saying that it should be expensed. Okay, because it is an expense. Ultimately, that is only what is happening. No, see, without transaction cost, what was the income I was booking? Sir, I was booking 46,372. With the transaction cost, how much income I am booking over the 5-year period? I am booking 45,000. That means ultimately 1,372, where it is going? It is ultimately going in the P&L only. But in what form? Can you see 1,372 a specific figure? No. The transaction cost is going and reducing the effective interest rate. And by virtue of reducing the effective interest rate, the overall income which I am recognizing over the 5-year period is coming down by the amount of transaction cost which you have paid. And that is what is the impact of transaction cost. Is it okay? Yes. Are you able to follow? Are you able to understand amortized cost method? ये जो figures है ना, these figures what we are getting, closing balance, उसी को हम लोग amortized cost बोलते हैं. We call that only as amortized cost. Okay, उसी को हम लोग amortized cost बोलते हैं. Okay, all right. So let us move on to the next one. The last extra question for today, then we come back to our study module and all that. But these questions I feel were essential to drill the concepts of amortized cost within you. Okay, so shall I proceed further? तुषार समझ में आ गया आपको? Okay, all right. So let us move on to the next one, the last one, extra question. Issue price 88,628, face value 1 lakh, redemption 1,10,000, coupon rate 7%, term is 5 years. Acha, without calculating, okay, please tell me, ज़्यादा थोड़ा सा सोचो, think a little bit and tell me over the 5-year period, what will be the total interest income that will be recognized? Without any calculation, in this question, what will be the total income that you will recognize? I'm having a redemption happening at a premium of 10,000 rupees and I'm the investor. Okay. So quickly tell me, thoda sa soch ke, we had recognized 46,372 on a plain transaction. No transaction cost, no premium. हमने कितना recognize किया था? 46,372. Now in this case, the bond is getting redeemed at a premium. So you tell me now, What will be the total income that I will recognize in the profit and loss? 46,372 plus 10,000. इतना आ गया ना आपका आंसर, that means you are on the right path. कुछ गलत नहीं है. Okay? And इतना ही आएगा. You will exactly come to 56,372. आप देख लो. Okay? All right. Now, again, we will have to calculate not 35, Janvi. 35 is not going to be your income. 35 तो coupon rate हो गया ना बेटा. 35,000 is coupon rate. Your actual interest that you have earned is 46,372, not 35,000. आप अगर 35,000 की बात कर रहे हो, then you should also take that 11,372 gain on redemption. Yes or no? So forget 35, forget 11,000. That is accounting standard. You have to remember that on the plain bond with no transaction cost, no interest, no redemption premium, you have booked an interest income of 46,372. To that, the redemption premium of 10,000 will be added. Okay. So now it should come to 56,372. All right. So now coming back to this, we have to calculate the EIR. So EIR will be more or will it be less? Sara socho. कितना हमने invest किया? 88,628. How much am I going to get? Sir, I am going to get 1,10,000. पहले कितना मिलता था? Sir, 1 lakh. 1 lakh जब मिलता था, 88,628 to 1 lakh, the rate was how much? 10%. Now it has increased to 1,10,000. So what will be the impact on effective interest rate? The impact on EIR is going to increase because my return is increasing. Na? My return is ultimately increasing. So your EIR will start to increase. Okay. So I start with 11% check and get 91,151. You can do annuity calculation also, or you start with 12% and get the amortized cost workings. Get the effective interest, get the present value of cash outflow. Your present value is 88,628, which is lower than 91,151 and higher than 87,650. So is it between the range of 11% and 12%? Answer is yes. It is within the range of 11 to 12%. And therefore, how am I going to calculate? Same extrapolation techniques. You can use any one of them and proceed to calculate the remaining. Okay. All right. So therefore, this takes care, and ultimately we get the effective interest rate of 11.72%. Okay, which is higher than 10%. Which is higher than 10%. Okay, which is higher than 10%. Are we able to understand? Are we following? Yes. These are just calculations. Okay. I want you to try this out at home. Okay. Try this out at home, because मैं करते बैठूंगा, you will do it. We'll spend each question. We already are spending about 15 minutes on an average. Okay. 10 to 15 minutes. If we end up doing it, it will be 20 to 25 minutes. Okay. Are you able to follow? Yes, are you able to follow? Yes. Any doubts? Anyone? Am I being too fast? If I am fast, I can slow down. But it's repetitive. That is why I'm a little bit fast. But if you want me to run you through each working in detail, I can do that also. Clear? Yes, anybody wants more clarity? Tushar, are you okay? Panu, are you watching? What about Namrata, Viraj? Is it okay? Jahnavi, is it okay? Yes, Jahnavi, is it fine? Okay, fine. Please confirm, guys. Okay, one more confirmation. Okay, all clear? Okay, fine. Tushar and Viraj, is it okay? Kaushiki confirmed, Jahnavi confirmed. Namrata, are you fine? Yes. Are you guys solving it? No response. Okay, nobody is responding. Looks like, don't know. Okay, so that takes care of the amortized cost manner of working. Okay, that takes care of the manner of working. All right, now coming to, is it always necessary that coupon rate and EIR will be different? Answer is not necessary. If issue is at 1 lakh, redemption is at 1 lakh, face value is at 1 lakh, coupon is at 10%, then coupon, IRR, everything is the same. It will come to 10% only. So what all is needed? You need to have issue same, face value same, redemption same, coupon becomes equal to your IRR. Okay. So therefore, most of the loans which you see, most of the loan contracts which you see, typically large loans, wahan pe they do not have transaction costs, etc. because the ticket size is large. Uh, so therefore, you can have companies with loans of 15 crore, 20 crore, 30 crore, 100 crores. Yahan pe transaction costs will not be there. Okay. And you ultimately have to repay the exact amount what you have taken. So coupon rate equals to the EIR because the initial loan taken is at the same price. The repayment also happens of the same value without any premium or discount, and it will also not be taking the any prepayment into consideration. So everything works out as planned, as written, and therefore the EIR is going to be equal to the coupon rate. In fact, in most of the situations practically, the coupon rate is going to be equal to the effective interest rate. But yes, in public instruments, typically either they plan it that way or they will mention only the coupon rate. They will not be mentioning the EIR. They will not be mentioning the effective interest rate. Okay. So ये हो गया हमारा introduction to amortized cost. Introduction to amortized cost. All right. Fine. Transaction cost is done. Redemption premium is done. And now we come to transactions at fair value. We now come to transactions at fair value. Okay. One of the questions we have discussed yesterday, but we will look at the other questions today. transactions at fair value, or rather transactions not at fair value, what we call as off-market transactions. Off-market transactions. See, typically what happens is effective interest rate must be equal to the market rate. So if these two are equal, your transaction is at market terms, there is not going to be any difference between your price as well as the market price. But in several cases, you could be having a scenario, you could be having a situation where transaction price or the loans, the covenants what you have entered, the numbers what you have given, the rates of interest specified, these are not the same as that of the market. That means you have either ended up giving something extra or you are getting something which is hidden in the arrangement of the loan that is done. And that is something which we need to understand. That is something which we need to understand. Yesterday, we did one question, and that question dealt with an employee's benefits. That question dealt with an employee's benefits. Okay. I will just take a similar example right now. We will try to understand what exactly do I mean by employee benefits and how do I do the accounting of that. Okay. The question was done, but now we will look a little more deeper into that with the help of an example. Okay. So now you have given loan to employees. Face value 1 lakh. You have given a loan of a face value 1 lakh. Issue price 1 lakh. Okay. That means you have issued it at 1 lakh only. Term 5 years. Market rate of interest is 10%. Your coupon rate is 5%. Your coupon rate is 5%. Transaction cost is 0. Yes, you can write it down. Okay, transaction cost is 0. Okay. So now, loans to employees. What will you record it at? Will you record it at fair value through other comprehensive income? Will you record it at fair value through P&L, or will you record it at amortized cost? Think and give me the answer with reasoning. Okay, I'll just come in a minute. All right, fine. All disturbance is done. Now I can focus. Too many things. Okay. So it is right. It is a financial asset, number one. Secondly, it is a financial asset. You have a contractual right to receive cash. You pass the CCFC test. You pass the business model test of held to collect, and therefore you will do it at amortized cost. So if you have to do it at amortized cost, you will have to record this transaction at fair value plus transaction cost. But here transaction cost is 0. Now there is a problem. In the instrument which I have given to my employees, I am charging interest at 5%. Okay. But the market rate of interest is 10%. The market rate of interest is 10%. 1 second. No, wait a minute. I'll just modify this. If I introduce the coupon, it will unit. Coupon is 0. Okay. So I give an interest-free loan to my employees because they are working for me. But the market rate of interest on these transactions is 10%. Market rate of interest on these transactions is 10%. So now I want you to tell me, I have given a loan under accounting standard 13. I have given an advance which I will receive after some time. So therefore, the entry that I would pass was loans to employees debit 1 lakh to bank. This was what I would pass in year 0. Years 1 to 5, no entry. Year 5, I would pass the entry. In year 5, I would pass the entry bank account debit to loans to employees. You are getting the money back. So 1 lakh. Now, is there something wrong in this transaction? Is there something wrong in this transaction? Yes, there is something wrong. What is something wrong? Sir, you are giving a transaction without, you are entering into a loan arrangement without giving, without charging interest. Yes, because वो मेरा employee है. अच्छा. Will you do the same transaction with an outsider? I won't say employees are related, but वो आपका staff है. And because the employee is your staff, you will not collect interest. He is working with you. Salary तो आपका ऐसे भी कम है. So you give these kind of benefits to them. So there is the problem. By giving an interest-free loan, you are giving a benefit to your employees. Sir, क्या benefit दे रहे हैं? Are you collecting interest from them? Answer is no. If you are not collecting interest from them, the interest collection which you have avoided is an outflow. Yes or no? The interest collection which I have avoided is an outflow. हाँ, वो बात सही है. Any inflow avoided is an outflow. So if you have avoided the inflow, and you are saying that it is a staff benefit that I have extended, it is a benefit that I have given, then tell me one thing, isn't this benefit required to appear at some manner in the profit and loss account? अरे yes or no? आप कह रहे हो you are giving loan without charging interest because वो मेरा employee है, and this is a benefit which I am extending to him. If I am extending benefit to my employee, that fact should come somewhere in the financial statements. Here in this entry, वो किधर भी नहीं दिखता है. Under the erstwhile AS regime, accounting standards regime, you used to pass the transaction in its legal form. Loan account debit to bank, bank account debit to loan. Arey, but where is the benefit? Where is the benefit which you are showing, which you are telling you have given? Nahi hai wo. That benefit is not appearing, not visible in the financial statements. And therefore, Ind AS 109 tells us you will have to fair value this transaction. You have given a loan of 1 lakh without interest, agreed, but वो उसका true fair value नहीं है. That is not the true fair value. Your fair value has to be calculated because here the transaction is at off market terms. The transaction is at off market terms. Okay. So now let us proceed to calculate the fair value. That is the initial recognition. Initial recognition. Initial recognition. These entries are erstwhile accounting standards. Okay. Initial recognition. Okay. So now here initial recognition is always fair value plus transaction cost. Here fair value is to be calculated. Transaction cost is 0. So fair value is nothing but present value of future cash flows. Present value of future cash flows. ठीक है सर? तो present value of future cash flows क्या है? Coupon, which in this case is 0 plus principal. Plus principal. Okay. So what is the principal amount? Well, the principal amount is 1 lakh multiplied by present value factor 10% for the 5th year, because you are getting the amount at the end of the 5th year, and therefore it is going to be into 0.62092, and that is why the total value, fair value of this comes to 62,092. Are we able to understand this? Yes, this is the fair value. कहने को तो आपने 1 lakh का लोन दिया है, but वो fair value नहीं है. That is not the fair value. Why? Because that does not fetch you interest. That does not fetch you interest. And that is why we cannot record the transaction at 1 lakh, because the standard tells do the initial recognition at fair value. Fair value is 62,092. So the entry that I'm going to pass right now is loan to employees, debit 62,092. Okay. To bank. अच्छा सर, बैंक अकाउंट से तो physically 1 lakh is going out ना. You cannot say bank also 62,092. तो फिर वो बचा हुआ 38,000 odd वो जो भी है वो कहाँ जाएगा फिर? वो भी तो कहीं जाना चाहिए ना. So therefore ये तो बैंक से actually 1 lakh has gone out. So there is a balancing figure. There is a balancing figure. Okay. So 1 lakh minus 62,092, you have a balancing figure of 37,908. 37,908. Now the problem is, what is this 37,908? And in all the questions that we will be doing today, we will try to identify what could this possibly be. You will have to look at the relationship between the lender as well as the borrower. When I say lender or borrower, I don't specifically mean a lending borrowing arrangement. It could be a lessor and lessee. It could be a holding subsidiary. कुछ भी हो सकता है वो. It could be anything absolutely. Okay. But it should be something logical. Like here you cannot say it will be investment in subsidiary. कोई संबंध ही नहीं है. This is a transaction with your employees. This is the benefit which you have given. So you have two ways to think about it. You have two ways to think about it. Okay. So now when you talk about two ways, one method is you take it that this is the entire expenditure on staff welfare. So we will debit it entirely to staff expense and take the whole expenditure to the profit and loss account, which is in fact one of the correct solutions. I don't deny. So you can take it entirely to staff welfare. That is also allowed. or you can take it to prepaid staff welfare. You can take it to prepaid staff welfare. This is on the assumption that the employee has to remain for 5 years in service. Only for that purpose, he has been given an advance of 1 lakh without interest. So he has to continue here for 5 years. This is the assumption which is there. Now, if you think ऐसा कोई जरूरी नहीं है, वो कभी भी जा सकता है, वो अभी लेके अभी दे के वापस जा भी सकता है. Yes, and therefore you cannot say that it is necessarily a prepaid item. You can even expense it out, but choice is yours. Okay, so prepaid staff welfare, in exam you can always say that alternatively the prepaid staff welfare could be taken to the P&L entirely, in which case the answer would suitably change. Okay, so loan to employee debit, prepaid staff welfare debit to bank. Now what am I going to do? Now I will prepare, this is year 0. Now I will prepare a loan amortization table. Acha, is amortization table mein what will I have? I will have year, I will have opening, I will have coupon rate, and I will have closing. Okay, so now we start with year 1, 2, 3, 4, 5. 62,092. 6 effective interest डाला ही नहीं. Okay, effective interest rate 10%. So this comes to 6209. So 62,092 plus 6209. Coupon rate is 0. दिया है. Okay, so this comes to 68,301. 6830. 75,131. 7513. 82. 644. 8264. Ultimately, it should touch 1 lakh. So this comes to 9092. Ultimately, over the 5-year period, you are going to recognize how much interest. Total mat karo, bina total kiye bata do. What is the interest that you are going to recognize over the 5-year period? Don't total it up. फट करके बोलो, how much interest are you recognizing? Sir, I am recognizing 37,908 as my interest income. होगा ही ना यार. From 62,000 you are moving to 1 lakh. होगा ही approximately 38,000. So that is the interest which you are going to recognize in your profit and loss. In the prepaid staff welfare expense, I have 37,908. Now understand the story. It starts getting interesting now. You are having interest income 37,908. You are having interest income 37,908. At the same time, you are having prepaid staff welfare. Sir, ये कितने का है? ये भी same amount का है, 37,908. Sir, ये भी same amount का है, 37,908. That means, tell me quickly, am I recognizing same interest income, same prepaid staff welfare expense over a 5-year period? Yes or no? Am I recognizing interest income 37,908? Yes. Am I recognizing prepaid staff welfare into staff welfare expense over a 5-year period? Answer is yes. So tell me one thing. Am I recognizing same income, same expense over 5 years? Am I recognizing same income, same expense over 5 years? Yes, same income, same expense. तो इससे आपने हासिल क्या किया? तो ऑब्वियसली ये होगा ना सर, कुछ मैजिक होगा तो बताओ. कुछ मैजिक नहीं है. Is 37,908 actually earned by you? Is 37,908 actually earned by you? Is this money coming and sitting in your bank account? Are you receiving this money in your bank account? I'm talking about the interest income. I'm talking about 37,908. Is this money coming in your bank account? Answer is no, it's not. It's not coming in your bank account. It is notional. ये notional है. Yes, because आपके जेब से कितना गया? 1 lakh rupees गया, वो सब जानते हैं. Yes, everybody knows that 1 lakh has gone. You are not getting even 1 paisa income out of this 37,908. You are not receiving this. At the same time, are you actually paying something for staff welfare separately? Are you actually paying something for staff welfare separately? No. वो तो loan amount में it is included ना. What is this 37,908? This is essentially the interest which you have foregone, which is getting converted into staff welfare. So you are foregoing this. ये आपको नहीं मिल रहा है. And this is ultimately reported as this. Okay. This is the income you have not received. Income not received is equivalent to an outflow. That outflow is nothing but prepaid staff welfare. Are you able to follow it clearly now? Are you able to follow? Yes. So basically, I have a notional interest income. I have a notional prepaid staff welfare. Ultimately, over a 5-year tenure, both of them will ultimately, what you can say, both of them will ultimately reach out to a particular number, that is 0 at the end of 5 years. But over the 5-year period, am I recognizing income? Yes. Am I recognizing expense? That is also yes. Okay. I hope you are able to understand. Now the problem comes, sir, let us take my P&L. Let us take my P&L. Okay. Simple T form P&L banata hu. And this is years 1 to 5. Okay. So in year 1, what is your interest income? Sir, in year 1, my interest income is 6209. Then it comes to 6830. Then it comes to 7513. Then it comes to 8264. And then it comes to 9092. This is the interest expense, that interest income that you have recorded. And the staff welfare expense, that comes to how much? 37,908 divided by 5. So this comes to 7582, 7582, 7582, 7581, 7581. Sir, dono, if I go on an year by year basis, are these amounts the same? Are these amounts the same? Answer is no, they are not. And because these answers are not the same, don't say that हमने कुछ गड़बड़ कर दिया. अरे कुछ गड़बड़ नहीं किया आपने. Where the standard says within the period they should be the same. Nowhere it is mentioned. Okay. So therefore, what matters is ultimately your numbers should suit. Your numbers should suit the question at hand. Okay. So 37,908 is ultimately being what you can say, 37,908 is ultimately getting expensed on one side and recognized as income on the other side, such that after the 5-year tenure, both of them get written down to 0. Are we understanding? Are we understanding? Sir, actually, staff welfare should be equal to the interest foregone. That is 6209. ऐसा किधर लिखा है? Where it is written? Yes. Is it written anywhere? Matching concept तो आप लगा रहे हो. You are doing the matching concept. Where the standard talks about a matching concept. Standard तो कहीं पर बात ही नहीं करता है. Yes, standard does not say you match exactly the interest and the expense and report net. ऐसा किधर लिखा है? It is not going to happen. Okay. So now why this expense is taken in 5 equal amounts? See, okay, let me put it this way. If you are taking the expense in proportion to this, if you are taking your expense in proportion to the income, okay, what does it mean? Employee ने welfare लिया 6,209 के equivalent. Employee has taken the benefit at 6,830 equivalent. In the last year, 9,000. Are you able to justify the movement in staff welfare in this manner? Are you able to justify? I can justify this movement for interest income. I can justify this movement for interest income because that is a loan amortization which is happening. But on the expense side, can I justify my staff welfare expense as 6209 in year 1 and 9092 in year 5? Can I justify? Can I say that no, this employee did huge amount of work in year 5. Year 1 में उसने उतना किया ही नहीं. आपको सपना आएगा. Are you going to get a dream that this employee will give me the services equivalent to 9,000? No, वो employee है. वो एक साल में average काम करता है. दूसरे साल में भी he works on an average pace only. And same for year 3, 4 and 5. And therefore, the most logical, appropriate, reasonable way of allocating 37,908 is on a straight line basis. Okay. We cannot allocate it in the ratio of the interest income because it is difficult to understand whether employee is giving services in that particular proportion. So therefore, wo employee hai, every day he comes, he does work for the organization. So I will allocate it equally over the 5 years. Okay. See, the standard is not mandating you to match the cost and revenue. No. ये तो हमारा analysis है. This is our analysis that ultimately the notional interest income which you have booked is ultimately going to be written off as prepaid staff welfare. Is ultimately going to be written off as prepaid staff expense. Are you clear? अपने को समझ रहा है सब? Yes. Any doubts? Jahnavi clear? Namrata is not there. Namrata चली गई क्या? Tushar, is it clear? Viraj, is it okay? Yes. All right. 1 to 5 years table is clear. Okay. Everything is fine. Everything is clear. And that concludes my interest income. My prepaid staff welfare. Acha. Let me take you to another case now. Let me take you to another case. Let me take you to another case. And this case is of rent deposits. Okay. Rent deposits. Okay. Now, consider that I have 2 cases with me. Okay. Case 1, rent is 20,000 per month and deposit is 80,000. Okay. So this is the first case. Second case, rent is 15,000 per month. Deposit is 8 lakhs. Okay. EIR 10%. Okay. So this is Namrata. आपका कौन सा क्वेश्चन छूटा था? I answered that in I have answered your queries now. Second. Namrata, Namrata, Namrata. See, the last question I have from you is the trial and error method, which I have explained to you, Namrata. We did it for 2 questions. Okay. Now the problem is, if you have any other issue, I have not received the query about it. Okay. So please help me out if you have any issue. Okay. Now see, I have 2 cases. Flat 1 is a rent of 20,000 per month with a deposit of 80,000. Case 2 is a rent of 15,000 per month with a deposit of 8 lakhs. Okay, in both the cases, the effective interest rate is 10%. Okay, now tell me, under AS, which is cheaper? Which is cheaper? Okay, under AS, which lease is cheaper? Is case 1 cheaper? Is case 2 cheaper? Okay. Right now these are interest free deposits. Okay. Effective interest rate का तो देखेंगे क्या है, but right now these are interest free deposits. So therefore under AS, which lease is cheaper? Case 2 is cheaper. Yes, obviously. See, case 1, 2,40,000 बैठता है. Okay, 20,000 into 12. Case 2 sits at 1,50,000. So you will go jumping and say that case 2 is better. We will stay in case 2. But you have not looked at the deposit in case 2. Deposit is 10 times that of case 1. So देखना क्यों है? Why do I have to look at case 2? Sir, you have to look at case 2 because deposit is higher. Deposit क्या है यार? वो तो refundable है. हाँ, refundable it is, but is it with interest or without interest? Sir, क्या मजाक करते हो? Deposit तो हमेशा interest free होता है. And if deposit is interest free, then tell me, my friends, am I foregoing the interest on that deposit? Am I foregoing the interest on that deposit? हाँ, sir, of course I am foregoing the interest on that deposit. And if I am foregoing the interest on that deposit, then what is the rent? To 8 lakhs into 10%, that gives you 80,000. That gives you 80,000. So 2,40,000 plus 80,000, the rent is actually 3,20,000. Whereas here 80,000 into 10%, it comes to 8,000. So 1,88,000. 1,88,000. And therefore, now which is more cheaper? Sir, case, sorry, मैंने उल्टा किया क्या? मैंने उल्टा किया. My mistake. My mistake. 2,40,000 plus 8,000. 2,48,000. So this is 2,60,000. Okay. So this comes to 2,60,000. If I consider the interest foregone, then case 2 is in fact costlier than case 1. But what is going to appear under the AS regime? You will only see 2,40,000 versus 1,80,000 and conclude that case 1 is costlier, go for case 2. Okay, so this is a typical anomaly that everybody goes through because deposits are typically interest free. And if deposits are interest free, we will have to find out what is the fair value of those deposits. Acha, you tell me one thing. Is deposit a financial asset? 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 Yes. Sir, why? Because it is a contractual right. Yes. To receive what? To receive cash. And what is the condition that what is the accounting that you will follow? Well, it is a right to receive cash, and once the right to receive cash is established, it becomes a financial asset. We will look at the CCFC test or SPPI test. Am I there solely for principal and interest? Answer is yes. And if I am there solely for principal as well as interest, then look at the business model. Are you holding to collect it? Answer is yes. And if you are holding to collect it, we will have to ultimately do amortized cost. And when I do ultimately the amortized cost, that point of time, I will be recording the when I do the amortized cost entry, at that point of time, I will be recording the transaction with the interest thereon. Is it okay? Yes. Is it fine? Everybody understood? Hold to collect is fulfilled. That's right, Namrata. That's right. Okay. So absolutely right. All right. Now let us come to some questions. Acha. Another example of loan at no interest or concessional interest. Parent subsidiary. अच्छा, parent subsidiary होगा तो balancing figure where it will go? Balancing figure will go under investment. Okay, it will go under investment. Absolutely right. Okay. Next. If it is government and beneficiary, the difference goes under government grant receipt. Okay, so you are having the relationships which you can see. Okay, is it fine, everyone? Yes. Can we proceed further? Yes, investment in subsidiary. That's absolutely right. Okay, that's absolutely right. Anup, good morning. Okay, all right. So ये हो गया हमारा अभी तक का डिस्कशन. ठीक है, ये हो गया हमारा अभी तक का डिस्कशन. We take a quick break of about 10 minutes. It's roughly 10:10. We shall resume at 10:20. And once after the break, we will continue with questions on off-market transactions. Okay, very important from exam point. Today, I will complete all off-market transaction questions. Okay, we will solve some, we will see the solutions of some, but we'll have to finish it today. Okay, so we take a break. जानता हूं Anup. Good to see you. Okay, hope you are fine. All right. So we continue after a break of 10 minutes. ठीक है, मिलते हैं break के बाद with questions. Okay. All right. Manish. Okay. All right. Welcome back. Kaushiki, that's right. If you charge 5% instead of 10%, that is also an off-market transaction. But my focus was not on explaining the off-market transaction. I wanted to show this relationship. Okay, where I am booking an expense as well as an income, both of which are notional in nature. So that is why I took it as 0. If I had to take it at 5%, then thoda sa mera calculation बढ़ जाता था. So that is why I did not take that. Okay. All right. Coming back to our discussions, we'll now pick up certain questions on off-market transactions. Let us start. Come to illustration 25, page 12.57. Okay. Scope and definitions. I think this is done. Unit 2. Okay. Okay. Illustration 25. Okay. Fine. Welcome back. Okay. Anup, you're there. Acha. Is everybody back? I want to start the question solving. Okay. See, I am not interested in checking whether these two are equal under AS. What is my intent is I want to tell that AS is completely foregoing the fact that we are having an effective interest rate that is getting lost. Okay. So that is the reason why AS is not leading to a fair financial reporting. Okay. And uske wajah se we have shifted to something that is more fair valued in nature. Okay. So now let us start our discussion with illustration 25. With illustration 25, page number कौन सा है ये 12.57 illustration 25. Okay, all right, let's read it. A Limited has made a security deposit whose details are described below. Make necessary journal entries for accounting of the deposit in the first year as well as the last year. Assume market interest rate for a deposit for similar period to be 12% per annum. Whenever they give this data, this is a hint that it is an off-market transaction. Off-market transaction. जब भी ये hint रहता है, whenever these type of sentences are there, assume market rate to be so much, assume discount rate to be so much, whenever they give this, it is a hint that the transaction is off market. Somewhere there will be a gap. So let us see what is the gap. Date of security deposit, starting date is 1st April 20x1. Closing date is 31st March 20x6. It is in relation to a lease contract. Total lease period is 5 years and discount rate is 12%. It is this rate only, the same rate. Okay. Even if not given, we could take it as 12% based on the data given above. Security deposit is 10 lakhs. And the present value factor is 0.567427. Okay. You have to use this for the purpose of accounting. Okay. Coupon rate is not given. So therefore it is 0. Coupon rate is not given. Therefore it is 0. We cannot introduce any coupon rate arbitrarily. Okay. All right. Now let us start. Okay. Let us start the discussion. Okay. All right. So deposit, this is illustration 25. page 12.57. Deposit is interest free. Okay, deposit is interest free, but market rate is 12%. Therefore, fair value of deposit is equal to present value of cash inflows is equal to coupons plus principal. Coupons कितना है 0 plus principal कितना है sir? The principal is 10 lakhs. What am I going to multiply it by? Present value 12% for the 5th year. And have they given the present value? Answer is yes. 0.567427. 0.567427. So this comes to 5,67,427. This comes to 5,67,427. Is it okay? Yes. Are we clear with this calculation? बात समझ में आ गई क्या अपने को? We are considering that market rate of 12% for the purposes of discounting. Okay. All right. It is clear. So therefore, what they have asked is give the journal entries for accounting of the deposit. Okay. Now let us look at the journal entries. This is on 1st April 20x1. Security deposit debit 5,67,427. But how much have I paid? Sir, we have paid 10 lakhs. ये तो झूठ नहीं है. This is the money. You open the bank statement. वहां पे on the debit side you will find paid towards security deposit 10 lakh. उसमें कोई doubt नहीं है. So I am left with a balancing figure which is 4,32,573. Acha. Now you tell me what could this 4,32,573 be? What could this 4,32,000 be? Okay. Follow. This is a lessor and lessee relationship. You have paid the security deposit to the landlord for giving you the property on rent. So now you tell me what could this be? What could this be? Yes, Kaushiki already gave the answer. What about the others? What could this particular difference be? Why have I paid extra? Or what is the extra payment made towards? Come on, tell me. Tell me. You have made an extra payment, 4,32,000. Why is that? Is it lease payment? Lease payment to every year hota hoga na. This is something extra which you have paid. See, I normally pay monthly lease. Yes. Monthly lease rents. Yes. Along with the monthly lease rents which I pay, I have paid a security deposit. Agreed. The security deposit that I have paid does not charge interest. Agreed. Because I am not charging interest, I am not collecting the interest on the security deposit which I have paid. Yes. Because I am not collecting the interest on the security deposit that I have paid, that interest would be a cash inflow avoided. Because it is a cash inflow avoided, it would be a cash outflow. Agreed. What is this cash outflow, which is actually an inflow avoided? Sir, this is payment which is going to the landlord. So why it is going? Lease payment, sir, lease payment. So it is right, it is a lease payment. But my question is, किस तरह का lease payment? Sir, for the period of 5 years, contract का life है 5 years. So this is the lease payment made for a 5-year-old tenure. And therefore, what would be the appropriate classification? Sir, ये तो prepaid lease rentals हो गया. Like how we took prepaid staff welfare. This becomes a prepaid lease rental. This becomes a prepaid lease rental. Very good. तो prepaid lease rental करके हम account करेंगे. Prepaid lease rentals. But under Ind AS 116, the concept of prepaid lease rentals no longer exists. Instead, we give it a new name, which is known as ROU asset. That is, Ind AS 116 calls it as a right of use asset. Okay, so basically any lease contract, we no longer call it as a lease rent, etc. We have broken up the lease contract into a right of use asset and a lease liability. Treatment वही है, prepaid lease rent का जो हम करते थे, we would have distributed it equally. We would have divided the prepaid lease rentals on a straight line basis over the remaining tenure of the contract. Treatment तो वही रहेगा. But prepaid lease rentals, when we would transfer, we would call it as rental expenses. Here, when the ROU asset is being removed, we call it as depreciation. We call it as depreciation. That's the only difference. Other, सिर्फ नाम में फर्क है. Please take the revised names. Do not consider the earlier names. Okay. So therefore, this is the entry past: security deposit account debit, prepaid lease rentals account debit to bank, or ROU asset account debit to bank. Okay. Next. 31,320x2. Okay. We have to record this. Okay. What other entry will come? Well, I will be recording interest income on this deposit. So, security deposit debit this is for the interest. This is for the interest. So this comes to 5,67,427 into 12%. 567,427 into 12%. Coupon कुछ भी नहीं है. So 68,091. 68,091. Okay. To interest income. To interest income. And then what else is there? Depreciation. ROU asset. ROU asset. कितना है? 432,573 divided by 5. So this comes to 86,515. We call it as depreciation because Ind AS 116 requires it to be called as ROU asset, but otherwise the concept remains the same as prepaid rent. Okay, you want, you can send, but how are you going to send? We can check what is there. Okay, Viraj, you can check what is there. Okay. Are we following? Yes. Are we following? Yes. Kaushiki, did you understand? Jahnavi, did you understand? Yes. Don't type, Viraj. I'll just check it online. Okay. You can focus on the question. Are, did you guys understand the question? Yes. Somewhere I'm feeling that there is some communication gap. Either am I inefficient to understand your problems, or communication is not happening properly. Yes. Namrata, is it okay? Kaushiki, is it okay? Yes. Tushar Garg, is it fine? Good going? Okay. Okay, Kaushiki, it is fine. Yes. All right. Next. Now they have asked you 31,320x6. Last day of the last year, the entries to pass. So last year, what entry will be passed? Well, I will pass the entry security deposit account debit to interest income. This is the first. Second one, you will pass the entry for receiving the 10 lakhs because it becomes an interest-free deposit that is now refundable to you. So bank account debit to security deposit. This is 10 lakhs. And then the last case is going to be same depreciation debit to ROU asset. So that comes to how much? That is 86,515. 86,515. Okay. What is the interest for the last year? How am I going to calculate? Bolo. How am I going to calculate? Last year's interest. How am I going to calculate? पहले साल का पूछा, last year का पूछा. Yes, that is how you can work it out. Okay, so 14x5 interest 31,320x6. You will be paying 10 lakhs at the end, but this 10 lakhs includes interest of 12%. So what is going to be 12? You can do a cross multiplication. So 107,143. Okay, 1,07,143. Okay, and then this is going to be your interest. So the balance is going to be 8,92,857. 892, 857, 107, 143, giving you 10 lakhs. Okay. So therefore, the entry for interest okay. All right. I think it has resumed now. Some small technical glitch. Okay. So are we able to follow the last year's workings? Yes. Are we able to follow the last year's workings? Any doubts? Any difficulties here? Yes. Any difficulty? Any doubts? No doubts? Can we proceed further? Can we proceed further? Yes, let's proceed further. Okay. All right. So now extra problem is over. Okay. This is done. Now let us come to illustration 21. Unit 2. Okay. It is not necessary to show it in the form of a table. You can do this small working which we have done. You can do this working also and show it in the exam. You will get your full marks because they only have asked year 1 and year 5. So मैं इतना मेहनत करके why should I prepare the entire table when a simple alternative method is there? See, you could get this question for anything between 6 to 8 marks. Why you want to spend a lot of time doing the amortization table, etc.? You can take this alternative 107, 143 working and get the answer. It is also acceptable. But between amortization table and this working, दोनों में से कौन सा एक तो दिखाना पड़ेगा. Okay, you will have to show one among the two options which is available. Okay, so now let us come to illustration 21. You will be doing this by yourself for homework. Okay, this one you will be doing it by yourselves. It should not be very difficult. It should not be very difficult. Okay. Next, we come to an RTP question. I have some RTPs for you. Getting RTPs now. RTP May 2019 and May 2020. Okay. All right. Question 9. Okay. All right. So this is your RTP question on Ind AS 109. KK Limited has granted an interest-free loan. Idhar gaya wo? An interest-free loan. So coupon is equal to 0 of rupees 10 lakhs to its wholly owned Indian subsidiary YK Limited. So there is a parent and a subsidiary. No transaction cost attached to the said loan. Company has not finalized any terms and conditions, including the applicable interest rates. The board of directors are evaluating various options and requested your firm to provide your views under Ind AS in following situation. The loan given by KK Limited to its wholly owned subsidiary YK Limited is interest free and such loan is repayable on demand. So you will have to answer this first question. Second one is the said loan is interest free, repayable after 3 years. Current market rate of interest for similar loan is 10%. Considering the same, the fair value of the loan at initial recognition is 8,10,150. And then the said loan is interest free, will be repaid as and when YK Limited has funds to repay the loan amount. Based on the above, KK has requested you to suggest the accounting treatment of the above loan in the standalone financials of KK and YK Limited, as well as in the consolidated financials of the group. Consider interest for only 1 year in the above loan. Further, company is also planning to grant interest-free loan from YK Limited to KK Limited in the subsequent period. What will be the accounting treatment of the same under the applicable Ind AS? Okay, go through the question once again, please. Go through the question once again. Okay, fine. Thanks, Viraj. Thanks. Okay, read the question. All right. You guys read the question? Yes. So let us proceed to solve. The loan given by KK to its wholly owned subsidiary is interest free and such loan is repayable on demand. Repayable on demand, tell me, is it normal to charge interest or is it normal to keep it interest free? क्या लगता है आपको? A loan given by an entity to another entity which is repayable on demand. Whenever the lender wants, he can demand the repayment and he has kept that loan interest free. So tell me, is it normal for loans repayable on demand to be interest free? Or is it normal to attach interest to the loan? It is normal to be interest free. We have seen this yesterday. And therefore, by keeping it interest free, can I say that the loan is at market terms? Can I say that the loan is at market terms? And if it is at market terms, what is the entry that you are going to pass? Well, it will be loan account debit to bank, entire 10 lakh rupees. There is no requirement for any split that needs to be done. So the entry that will be passed here is, this is RTP question. RTP May 2019 question 9. Okay, yes. So therefore, the first part of the question, this is 9.1. books of parent, books of subsidiary. Okay, so the entry that will be passed here is loan to YK debit to bank 10 lakhs. And what will the subsidiary pass? What entry will the subsidiary pass? What entry the subsidiary will pass? Well, the subsidiary will pass bank account debit to loan from KK. ₹10 lakh. Okay. There is no off-market financing, no off-market transaction. So straight away, what is paid entirely is at fair value, and therefore it is taken to the balance, loan balances. Okay. Next. Now, let us move on to the next one. The second situation, the loan is interest free, repayable after 5 years from the date of granting such a loan. The current market rate for a similar loan is 10%. Considering the same, the fair value of the loan at initial recognition is 8,10,150. Okay. Okay. Something is not right here. Let me just check. This figure is not right. Okay. ये जो figure है ना, that figure is not right. Just give me a minute. I'm just checking. Okay. This should be 751,315. Now it will be correct. Okay. Now it will be correct. 8,10,150 is not right. Okay. It should be 751,315. Now, is it a loan repayable on demand? Answer is no. It's repayable after 3 years. The current market rate of interest is 10%. The fair valuation is already done, and that is at 7,51,315. So is this interest free? Yes. Is it repayable on demand? No. Is it repayable after 3 years? Yes. Should it have been interest free? Answer is no. Because it is interest free, this is a transaction off market terms. This is a transaction at off market terms. So what am I going to do? Well, it works something like this. Okay. This is second case. Okay, loan to YK debit 7,51,315 to bank 10 lakhs. Where will the difference go? Yes, What is this? This will be investment in subsidiary. Investment in subsidiary, or we can call investment in YK Limited. Okay. Next, what entry the subsidiary will pass? Subsidiary is getting the money. So bank account debit. Sorry. Subsidiary is getting the money. So bank account debit. 10 lakhs. To capital contribution. How much is that? 751,315. Sorry, not capital contribution. To loan from KK. So 248, 685. So this is the entry that you are going to pass for the transaction, which is repayable within 3 years, whose coupon rate is 0, but the market rate is given in the question. So therefore, you will have to. Done? Yes. Investment in subsidiary done. Okay. Now the last part, and the last part is a little bit tricky. You will have to help me out with this. The said loan is interest free, will be repaid as now and when the YK Limited has funds to repay the loan amount. Okay. Yes. 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 Okay. I'm having answers. It is an equity. It is not a financial asset. Okay. All right. Now, loan is repayable on demand, but at whose option? The loan is repayable on demand at whose option? It will be repaid as and when YK Limited has funds. It will be as and when YK Limited has funds. Now, will it always have funds? I do not know. Do I need to estimate when it will have funds? Answer is yes. You are need to estimate the number of years it is expected to take for YK to generate sufficient funds. Okay. And accordingly, you will find the fair value and solve as mentioned above. Okay. In the CFS also, the debit and credit will get cancelled and ultimately the net impact is going to remain. Okay. So therefore, you have to perform an estimate and then do the workings. Now that data is not given to us, so we cannot be doing that. Okay. So that takes care of this part. Let us then move on. Let us then move on to the next sub question. The company is also planning to give an interest-free loan from YK to KK. What will be the accounting treatment of the same under applicable Ind AS? Okay. Interest-free loan by subsidiary to parent. What do you guys think? Yes? Tell me. The subsidiary wants to give loan to its parent. What is it going to be? Yes, show as dividend. Show it as dividend distribution. The balancing figure which is typically there will go in as a dividend distribution. Is it okay? Yes. All right, it will go in as distribution of dividend. All right, so you can show it as dividend distribution. Parent will show it as dividend received. So that should kind of take care of the accounting. Okay, so all the four conditions. First one, loan repayable on demand, no coupon rate, no interest rate. Straight away, transaction is at market value. Take 10 lakhs as loan as well as credit to the bank. The second case is loan to, loan with a repayable contract stipulation, and therefore we will do a fair valuation. And doing the fair valuation, any value is going to sit in investment in YK Limited. Okay. So that is how you are going to do when there is a defined tenure. And then the last one is when YK wants to distribute, what will be the treatment? It will not amount to any other thing other than distribution of dividends. So it will be a distribution of dividends. That's it. Okay. So now let us look at point 3. What do you mean by point 3? Okay, this one. The loan is interest free and will be repaid as and when you are going to have funds. Acha. Now, is the loan repayable? Yes. So is it representing an obligation to deliver cash? Answer is yes. So if it is representing an obligation to deliver cash, does it mean it is a financial liability? Answer is yes. So if it is a financial liability, will you have to record it at its fair value? Answer is yes. So if I have to record it at fair value, I need to know what is the interest rate in the market? What is the interest rate in the market? So you proceed to calculate the interest rate. But the first thing that you see when you find the interest rate is uncertainty in the maturity timelines, because the period is not dependent on passage of time. The period is dependent on availability of funds. It may be available immediately. It may be available after 1 year or even thereafter. So therefore, before I proceed to calculate or determine the effective interest rate, I will have to proceed to calculate. The estimate that the entity receives funds. So how do I do the estimates? I will look at their projected financials. I can look at their projections, and basis that we can do a calculation. So right now there is no way we can pass any entry for this. Right now there is no way we can pass any entry for this. Only theory is the answer. Okay. Once you get the estimated period, then you can apply the effective interest rate, do the discounting, and then do the accounting. But right now, it only has a theoretical answer. It does not have a practical answer. Okay. तो ये हो गया मेरा RTP 2019 का question. Okay. All right. Next. So that question is done. Let us then move on to the next one. RTP May 2020 question. Okay, page 6. Okay, mark this particular question as very important. Okay, mark this question as an important one. We will have to try and get this moving. Okay. Okay. I have requests to take the exam question also. 1 second. Just a minute. So this is which question? A23. Could you please help me? Which question that is? All right. Okay. In the question number 10, please. XYZ issued rupees 4,80,000 4% preference shares, redeemable preference shares. Redeemable, that means, is it mandatorily an obligation to deliver cash? Answer is yes. Interest is paid annually in arrears. First payment of interest amounting rupees 19,200 was made on 31st March 2006 and it is debited directly to retained earnings by the accountant. The preference shares are redeemable for a cash of rupees 7,20,000 and on 31st March 2008, the effective rate of interest on the redeemable preference shares is 18% per annum. The proceeds of the issue have been recorded within equity by accountant as this reflects the legal nature of the shares. Board of Directors intends to issue new equity shares over the next 2 years to build up cash resources to redeem the preference shares. Mukesh, accounts manager of XYZ, has been told to review the accounting of aforesaid issue. CFO has asked from Mukesh the closing balances of preference shares at the year end. If you are Mukesh, show how much help you would have shown to CFO on analysis if you sell the stated issue. Prepare necessary adjusting journal entry in the books of the accounts as required. Okay, in the books of account as required. Okay. Acha. First of all, are these instrument financial liability or equity or a compound financial instrument or pure equity? What it is? I need you to look and tell me. I need to look and tell me. Is it a financial asset? Is it a financial liability? Or is it equity? Or is it both? Yes, what it is? Yes. What do you guys think? Is it a financial asset or a financial liability? If XYZ has issued preference shares, so this is issue. So XYZ is getting the money. Which type of preference shares? Redeemable. That means is the instrument financial liability as far as principal is concerned? Answer is yes. Can you move on to the next one? And interest is paid annually in arrears. So automatically it becomes what we call as 4,80,000 redeemable preference shares are financial liabilities. Okay, not equity and no equity component also. It may be called a pure, it may be something else, but you have to take it as a financial liability because of the mandatory redemption and mandatory arrears payment of interest. Arrears payment of interest. The first payment of interest amounting to 19,200 was made on 31st March 20x6. अच्छा कैसे आया रहेगा ये 19,200? Just pick up your calculator. 4,80,000 into 4%. 4,80,000 into 4%. Yes. So 4,80,000 into 4%. How much does it come to? 19,200. So this is what is debited, and where has it gone? What has the accountant done? The accountant has taken it where? The first payment of interest was made on March X6 and debited directly to retained earnings by the accountant. Is it correct? Is it correct? The first payment of interest was made on 31st March X6 and it is debited directly to retained earnings by the account. It is taken to retained earnings. वो बेचारा क्या समझता था? Preference share है, so it is like dividend. So dividend should go to retained earnings. So he has taken it directly to retained earnings. Is it correct? Answer is no, it's not. Why? Because this is coupon rate. 4,80,000 into 4% is merely a coupon rate. What is actually what we say? What is actually the interest is based on effective interest rate. Am I given the effective interest rate? The effective interest rate is 18% per annum. What is 4%? वो तो coupon rate है. Coupon rate और effective interest rate में there is a lot of difference. Okay, coupon rate is the rate for making payments dependent on the face value, whereas effective interest rate is that rate which equates the present value of cash outflow with present value of cash inflow. Both of them are very different, what you can say, both of them are very different terms with different meanings. Okay, so number one mistake is debiting retained earnings. Okay, that means crediting retained earnings. The second mistake is that your calculation is at the coupon rate and it is taken to retained earnings, whereas in fact it should go to the profit and loss account. It should go to the profit and loss account. So both figures are also wrong, as well as the treatment in accounts also is wrong. Acha, if effective interest rate is not given, yaar dena chahiye. Either you give effective interest rate or say it is 0%. Okay, you cannot have an instrument without an effective interest rate. Without an effective interest rate. Okay, so ये हो गया हमारा, the effective rate of interest is 18% per annum. Okay, all right, next, let us move on. The proceeds of the issue have been recorded within equity by the accountant. Proceeds have been recorded within equity by the accountant. Bolo, is this correct? Should the proceeds of the issue be recorded within equity? Should it be recorded within equity? क्या लगता है आपको? Should it go to equity? Right now, we have seen the nature of the instrument. The nature is a financial liability. So should it go to equity? Answer is no. And therefore, if it should not go to equity, what the accountant has done is incorrect. What the accountant has done is therefore incorrect. We will have to do a rectification entry for that as well. We will have to do a rectification entry for that as well. Okay. Yes. Are you convinced? Next. Next. Let us then move on. The board of directors intend to issue new equity shares over the next 2 years to build up cash resources to redeem the preference shares. Okay. So lot of mistakes are there. We will have to make the rectifications accordingly. So let us start first. So now this is RTP May 2020, question number 10. Okay, question 10. All right. First one is, we will have to record the transaction at its fair value. Is it currently at fair value? You are given the coupon rate of 4%. 18% is effective rate of interest. This is not the market rate of interest. This is not the market rate. Yes, 19,200 will be a cash flow. Okay. This is not the market rate of interest. And if it is not the market, okay, this is the effective interest rate, not the market rate of interest. Look in the question. Anywhere have you been given market rate of interest? Look in the question. Anywhere have you been given the market rate of interest? Answer is no. You haven't been given the market rate of interest. Ab kya kare? Now what to do? Only one option. Take effective rate of interest itself as 18% per annum being your market rate. That is the only case. But sir, if we take effective interest rate to be equal to the market rate, it means the transaction is already at fair value. Yes or no? See, for the same financial instrument, the same conditions, the effective interest rate is 18% per annum. We have considered that. But if you still want to confirm, we can again do an effective interest rate. We can still do a liability calculation. We can still proceed to calculate the fair value of the liability, and then we can proceed to be satisfied about the figure. Okay. So therefore, let us start with fair value at initial recognition. Fair value at initial recognition is equal to, are we getting coupons out of this? Yes. 4,80,000 into 4%. Interest is paid annually. 4,80,000 into 4%. This is the annual coupon which you are going to pay. Present value annuity factor 18% for 3 years. So that comes to how much? That comes to 2.71743. Plus, are you going to get back the principal? Yes, because this is a redeemable bond. Okay, this is a redeemable bond. So principal also is going to come. Okay, plus what is going to be the principal? Well, the principal is the preference shares are redeemable for cash amount of 7,20,000 on 31st March 20x8. So plus 7,20,000 into present value factor 18% third year. So 7,20,000 into 0.6086. So now when you do the comparison, what am I getting? What am I getting when I do the additions, subtractions, whatever is there? 19,200 into Yes. Mhm. 4,79,940 or 60, whatever it is. Okay. It's a rounding of error. Yes. So 4,79,940, 4,79,960. Can I say that it is almost equal to 4,80,000? Can I say that it is almost equal to 4,80,000? Are yes or no? Janvi, check your answer. Nakul gave the answer. Kaushiki, did you get the answer? Your answer also is not right. Yes, you are not only receiving the principal, you are also receiving the coupon payments of 19,200 every year. Yes or no? So therefore, you will have to check your answer. There could be some small mistake there. Okay. Okay. All right. 7,20,000 into 0.6086. Plus 41,747. So is it almost equal to 4,80,000? Yes. And because it is almost equal to the fair value, what does it mean? Is the transaction happening at market terms? Is the transaction happening at market terms, or is the transaction happening at off market terms? Sir, the transaction is happening at which terms? Market or off market? Jaldi bolo. Tell me quickly. Is the transaction happening at market terms or at off market terms? Bolo. It is happening at market terms. So will there be a component as a balancing figure? Answer is no. कोई component नहीं रहेगा. 4,80,000 only will be the value at which the financial liability is going to be recognized. You will be recording the financial liability at 4,80,000 itself. That's it, nothing else. Okay. Acha, but what will be happening subsequently? Subsequently, do I have to prepare an amortization table? Answer is yes. So what is the question asking? Well, the question is asking you, the CFO has asked from Mukesh the closing balance of preferences at the end of the year. So when I have to calculate the closing balance at the end of the year, do I have to prepare an amortization table? Answer is yes. So to that amortization table, I will calculate the interest rate at which percent? Will I calculate interest at 4% coupon rate, or will I calculate at 18% effective interest rate, or will I calculate it at 18% market rate? You will have to prepare an amortization table because the CFO needs the value at the end of year one. End of year one means we start with opening balance, we take interest, we deduct the coupon, and we get the closing balance. तो आप कौन सा rate लोगे? Which rate are you going to consider for the purposes of calculating the interest? Will you consider 18% effective interest rate, or will you consider the 4% coupon rate? You will consider the effective interest rate. You will consider the effective interest rate because this is a financial liability, and financial liability always records the interest under the amortized cost method at effective interest rate, not at the coupon rate. The coupon rate is merely a payment that is being made, and therefore you will pass the entry at, you will record interest at 18%. Or you cannot take the coupon. That is what I'm telling you. Coupon C, coupon will never be equal to EIR except in the rarest of the rare cases. Coupon will not be equal to IC. Understand one thing. Coupon, effective interest rate, market rate. These are three different things. Don't get confused. Coupon, effective interest rate, market rate. Don't get confused here. I'll explain the amortization. Don't get confused here. Okay. See, the coupon is basically periodical payments. Periodical payments. This has nothing to do with recognition of expense. With recognition of expense. The effective interest rate is basically your rate for determining the interest expense in the profit and loss account. This is the rate which you are going to take. It is not necessary, action is not at market terms. Please don't come to the conclusion that if this is not equal, the transaction is not at market terms. No. In this question itself, what is happening? EIR equals market rate. EIR equals market rate, but EIR is not equal to coupon rate. Is the transaction at market terms? Hai to yaar, we calculated, we got the fair value as 4,80,000, which is exactly the price at which the issue has happened. You can see the question. Issued 4,80,000 preference shares rupees. So that means the issue is 4,80,000. Initial recognition has to be 4,80,000. So can I say that the transaction that has been entered into has been entered at market terms? Yes or no? And therefore, it is not necessary that coupon equals to EIR. It's a very, very, very special case. Okay. It happens only when lot of things become equal. Your issue price equals the redemption price. Coupon rate equals the EIR. So lot of equal to will happen. Only then your coupon rate is going to be equal to the effective interest rate. For example, if I have to tell you when the coupon rate is equal to the EIR, it will happen when issue price is equal to the face value, is equal to the redemption value, and there you have a coupon rate. If this is the case, then and then only the coupon is equal to the EIR. Otherwise, it will not be equal. And even if they are not equal, it doesn't matter. Okay. Transactions can be at market terms even when coupon is not equal to EIR, because you look for EIR equaling market rate. If EIR equals market rate, the transaction is at market terms. See, this particular concept, EIR versus market rate, is very, very important, because I will be using the same concept for separating debenture liability component and equity component in a convertible debenture when we do conversion of convertibles. Okay. When we do split accounting of convertible instruments like debentures, convertible debentures at the option of the holder. So when I do the split accounting for these instruments, I need to be sure what is my effective rate of interest and what is my market rate of interest. This is going to help me. Okay, so therefore don't get confused between coupon as well as the effective interest rate. Is it okay? Yes. So now in this case, let us proceed to prepare the amortization table. Let us proceed to prepare the amortization table. How to prepare the amortization table? Well, we started this way. Okay, so amortization table. Year 1, 2, 3. How many years it is? On 31st March X8. So 5, 6, 6, 7, 7, 8. So it is for 8 years. sorry, 3 years, sorry, year, and then you are having opening balance. Acha, tell me what will be my opening balance? Sir, my opening balance is going to be 4,80,000. Is it the fair value? Answer is yes. This itself is your fair value. Effective interest rate at 18%. Is it market value? Yes. So transaction is at market term. So 4,80,000 into 18%, 86,400. Coupon rate at 4%. So this comes to how much? This comes to 19,200, which is paid. So that gives me how much? That gives me closing value of 5,47,200. 5,47,200. Okay. All right. अच्छा, without calculating, अभी ध्यान से देखो, get your concepts right. Don't calculate the amortization table. Tell me, before repayment of the liability, my amortization table कितने पे आके बैठेगा? At what closing value will my amortization table go and sit? At what closing value? Don't calculate. Without calculating, look at the question. We start with 4,80,000. EIR is 18%. Coupon is 4%. At what value will the amortization table go and close before the repayment? It will be 7,20,000. It will be 7,20,000. It has to be 7,20,000 because the movement between 4,80,000 to 7,20,000 with the 19,200 coupon payment is resulting in an effective interest rate of 18%, and we are doing the amortization table with the 18% effective rate of interest, and therefore if we proceed to calculate the amortization table entirely, 5,47,200, it is not required, but I'm just explaining to you, into 0.18, that gives you 98,496, 19,200. So 547,200, 98,496 minus 19,200, 6,26,496. So opening balance 626,496. $7,20,000 you take. Coupon will be 19,200 as usual. Okay, so 7,20,000 plus 19,200. So this comes to 1,12,704. Sir, आपने उल्टा क्यों किया? Calculate it correctly. So let us calculate correctly. 6,26,496 into 0.18. 1,12,769. What is the difference between these two? The difference between these two is just 65 rupees. The difference between these two is just 65 rupees. So can I say effective rate of interest is 18%? Yes. Effective interest rate is 18%. Why this gap has come of 65 rupees? Remember, ye jo fair value tha, this was not coming exactly 4,80,000. It was coming 4,79,940, 950, 960, something like that. So we did a rounding off. Instead of 18%, if you had to take probably say 18.1% or 17.9%, then your answer would be correct. Then your answer would be correct. So 26, 60 rupees. यार ये सब छोटे छोटे चीज है ना. You can overlook that. Okay. In an instrument which is worth 7,20,000, 60 rupees का कुछ मायने नहीं रखता. It's not really material. Okay. See, the problem that we face in real life as well is, academically it's very nice to see things going absolutely accurate, etc., etc. But in reality, you have these instruments which run into crores and crores of rupees. When it runs into crores and crores, just imagine Reliance Limited's balance sheet. Reliance Industries Limited ka balance sheet dekho. Uska turnover is running to more than 20-30,000 crores. Balance sheet size is a hefty balance sheet. Do you think that if they don't have fixed assets of 1 crore, they are unable to trace? Do you think it will be a material impact? वो तो rounding off में निकल जाता है. It ultimately goes away in rounding off. So therefore, even in these cases, small differences like 20, 30, 60 out of an instrument having a liability of 7-8 lakhs, just ignore that difference. It's too immaterial. So you can do a backward working and determine the effective interest rate. Okay. So now coming back to the entries, we actually have to do some rectification. First, let us understand what are the wrong entries passed. What are the wrong entries passed? Okay. Now, the wrong entry passed is, first one, issue of preference shares is taken to equity. So he has passed the entry bank account debit 4,80,000 to 4% preference shares equity. He has taken it under equity. Don't lie. You would also do the same thing if it was under accounting standards. Yes or no? You would also do the same thing if it was under accounting standard. यो बेचारा accountant है, उसको Ind AS नहीं पता. So therefore, he has passed this entry. Okay. And then again, he is a normal accountant. One second, please. So when preference dividend was paid, when he was instructed to pay the preference dividend, तो वो बेचारे ने क्या किया? He has paid the dividend and taken it to retained earnings. So retained earnings debit to bank 19,200. 19,200. So this is the entry that he has passed. You can check here. XYZ issued the proceeds of the issue. This line. The proceeds of the issue have been recorded within equity by the accountant as this reflects the legal nature of the shares. So this is what he has done. Then the first payment of interest made amounting to 19,200, the second and third line is debited directly to retained earnings. उसको लगा वो dividend है, so he has taken it to retained earnings. But is it dividend? Answer is no. It's mandatory payment of coupons, mandatory payment of the principal, and therefore it meets a pure financial liability. ये तो compound भी नहीं है. It's not even a compound financial liability. Compound financial instrument. It is a normal financial liability, and therefore this entry is wrong. What should have been the correct entries? Can you please help me? What should be the correct entries? Can you please help me? Yes. Bank account debit. Bank account debit. Yes. 4,80,000. Can you help me please? To 4% preference share capital. Financial liability. 4,80,000. That is right. What is the second entry? Sir, interest ka entry. So that is for how much? 86,400. So what is the entry that I'm going to pass? Interest account debit 86,400 to 4% preference shares. Financial liability 86,400. Yes or no? And finally, the payment, coupon payment. What is the entry for the coupon payment? Well, the entry for the coupon payment is going to be 4% preference share capital debit 19,200 to bank 19,200. Are you in agreement with these entries? Are you in agreement with these entries? Yes. Absolutely right, Nakul. Yes, absolutely right. All right. But these entries are already passed in the system. See, it must be an ERP. In ERP, the entries are already passed. So what you are required to do is prepare adjusting journal entry if required. They have not asked normal journal entries. They have asked for adjusting journal entries. So we will adjust the journal entries. So this is my rectification entry. Achha. Please pay attention now. Okay, please pay attention. I have wrongly booked equity. Do you agree? I have wrongly booked equity. Yes, you have wrongly booked equity. So therefore, I will have to remove it from equity. I will have to remove it from equity. And if I have to remove it from equity, what is the journal entry that I'm going to pass? The first thing I'm going to do is preference share capital equity debit 4,80,000. So उससे क्या हो गया? This is removed. This is removed. Okay. This entry is removed. Okay. Bank is okay. So bank we don't need to do any rectification. Okay. वो तो उतना तो उसको आता है. अच्छा. Retained earnings were debited. So should I debit retained earnings? Answer is no. It is finance cost. So I will record this finance cost. Where is my finance cost? 86,400. Finance cost P&L debit 86,400. 86,400. Okay, sir, in this case, we are considering it to be market term. We are not considering. वो आ गया ना, it came to 4,80,000. We did the fair value calculation, Janvi, and it came to 4,80,000. That is why it is market term. We are not assuming it. Okay, we are not assume. हम लोग assume नहीं कर रहे हैं. वो actual में आ रहा है. Okay. So, how much maximum difference should be there between fair value as per PV method and amount given to consider market terms? कोई difference नहीं होना चाहिए. You can have some small immaterial differences. वो judgment है. 1%, 2% is okay. Okay. जैसे 7,20,000 में 100 rupees और 60 rupees, 50 rupees is fine. You can conclude that it is at market terms. Okay. Koi guidance is not there. Okay. There is no fixed guidance. So institute also will ask you the things where it is almost going to get equated to the market value as well as the EIR. Okay. So don't worry. All right. Now, the next one is retained earnings were wrongly credited. So we will debited. So we will have to credit it. To retained earnings 19,200. Yes. Next one to 4% preference capital financial liability. Can I say that this will be 5,47,200 directly? Because this is rectified at the end. So this comes to 5,47,200. Yes. Sir, kaise? 4,80,000 plus 86,400 minus 19,200. So can I say the closing balance will be 5,47,200? Yes. And now you can check 480 plus 86,400. should be equal to 547,200 plus 19,200. Okay, plus 19,200. Yes, that is right. Okay, so Janvi's query got addressed. Namrata, your queries are left out. Any queries are left out? No queries left out, no? Yes. So this completes a very important question on your accounting for financial liabilities. It was a good question. It is a good question. Okay, so आपका rectification भी हो गया, थोड़ा intermediate का भी आपको ये लगा. Yes. Reminiscences of intermediate or foundation, rectification of journal entries. I think foundation. Okay, so this takes care of the RTP question. Any doubts in the RTP question? Any doubts in the RTP question? No doubts. Okay. Retained earnings as credited. Yes, I have to remove this now. This debit which is there, let me mark it separately. This is wrong. So that is why it is rectified by crediting it. Okay. So that is why retained earnings is credited. Okay. All right. Fine. Let us proceed. How is the Josh among all of you? Yes. Shall we proceed for more questions? Or are you guys tired? Till inter you are accountant, yaar. Final baate hi aapke na sing nikal aate aise. You become chartered. Okay. But just as a matter of joking, the whole process of you clearing your foundation, then becoming inter, and then moving on to final, it is a very, very enjoyable journey. Personally, my student life was very enjoyable. Okay. And I hope that your student life also would definitely be very enjoyable, and you continue to reach pinnacles of success in your academic life. It's never the end of the journey. Okay, when you qualify as a chartered accountant, it's never the end of the journey. It is the beginning of a new one. So the way I look at it, right now you have a defined goal in life, that is, you want to qualify your chartered accountancy. But the whole problem arises once you qualify. Okay, you should have a clear-cut goal in life. Okay, like what you want to be. Nothing is inferior or not suitable. You should know, if practice suits you, you should go in for practice. If corporate suits you, go in for corporate. If consultancy firm suits you, go into consultancy. The choice is yours, but you have to be clear about it in the 2 months that is there for you. Okay, so all have lot of opportunities. Okay, outside practice has immense scope, corporates have immense scope, and even MNC consultancies have immense scope. Okay, it's up to you to decide. You will in fact come back to me telling that if we meet sometime in the future, or you will tell to yourself, yaar isse acha to hum bacche hi the. Kyunki the life that we study, somebody is there to take care of us in most of the cases. Okay, it's a very secure life, a very secure surrounding that we have. Okay, it's not going to be the same once you qualify, but once you qualify, challenges are of a different nature. You don't have the pressure of clearing exam. You have another type of pressure to earn, probably to provide for a family. Those kind of things will start coming into play. Okay, anyways, so this concludes the question on what you say on that rectification question. So this is done. Let us move on to the next topic, the next question. Okay. Okay, let us look at a couple of questions. I'll be taking some questions. Please let me know if you are going to feel a little more tired than necessary. Okay, because at Sunday hai, I thought I will take up some questions with you. Okay, all right. So now What is this? Okay, all right. Now, this is interesting. Okay. A Limited has made a borrowing from RBC Bank. So A Limited, it is a financial liability. RBC Bank, it is a financial asset. For 10,000 at a fixed interest of 10% per annum. Loan processing fees were additionally paid for rupees 500 and loan is payable after 5 years in bullet repayment. In bullet repayment, uh, 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 of principal. Bullet repayment means a single shot repayment at the end of the tenure. Okay, usko hum log bullet bolte hain. Details are as follows. Loan amount rupees 10,000. Date of loan 1st April 20x1. Date of repayment of principal amount 31st March 20x6. Okay, all right. Interest rate 10%. Interest charged to be charged and paid yearly. Upfront fees is 500. How would the loan be accounted in the books of A Limited? How would the loan be accounted in the books of A Limited? Acha, we are in the books of A Limited. Tell me one thing, is A Limited the borrower or is it the lender? Is A Limited the borrower or is it the lender? Is A Limited the borrower or is it the lender? Borrower. Okay, so we are in the books of the borrower. Borrower ke case mein, there are only two types of accounting. See, financial asset had three types: amortized cost, FVOCI, FVTPL. In the case of financial liability, only two types. One is the क्या बोलते हैं उसको amortized cost and the other is FVTPL. OCI नहीं है for financial liabilities. अच्छा, when we talk about financial liabilities, we have only 6 categories. We will come to that, but we have only 6 categories where you are permitted to have FVTPL. It includes items like contingent consideration, uh, financial guarantees. All of those come under FVTPL. The others comes under, all other items come under amortized cost. So basically, till now, whatever questions we did, we were in the books of the investor, except for the last question where we did the accounting in the books of the borrower. Okay, the preference capital was issued. That means the company was borrowing, right? वो जो मुकेश वाला question था, where there was a rectification of error. So what did we do? We did a normal amortization liability question. Yes. So instead of financial asset amortization, we did a financial liability amortization. Doesn't matter. The ultimate output is an amortization, means opening plus interest minus coupon minus principal to give you the closing. That is a normal amortization style that you are going to have throughout the chapter on financial instruments. So whether it is opening or whether it is asset or whether it is a liability, amortization concept remains the same. But there is a small change when it comes to liabilities. Okay. See, if you recollect, I had given you a table. I had given you a table of transaction costs. I had given you a table of transaction cost treatments. And in that table, we had written that, no? Transaction cost. Yes, I had given this table to you Look at the transaction cost. Amortized cost method, transaction cost is added. FVT OCI for debt instruments, transaction cost is added. FVT OCI for equity, transaction cost is added. And FVT PL instruments, financial assets, the transaction cost is taken to the profit and loss account. Okay, this was the treatment. So in all the cases, transaction cost was getting added. Now let us come to liabilities. Let us come to liabilities. We will take this question only. We will take this question only. कौन सा है भाई? अच्छा. Now there is a borrowing of 10,000 from the bank, and there is an upfront fee of 500. There is an upfront fee for 500. Don't write down, just pay attention. Bank account debit 10,000 to loan financial liability 10,000. But tell me, to take this loan, you will immediately pay the processing charges, yes or no? So you will pay the processing charges, debit 500 to bank 500. So this is your transaction cost bolo, processing charges bolo, whatever name you want you can give. But the key is that what is the fund actually available with you for utilization? आपके पास कितना बच रहा है? Will you be able to utilize entire 10,000 rupees? Will you be able to utilize entire 10,000 rupees? Answer is no. Because out of 10,000, 500 you've already paid off, right? Out of 10,000, 500 you have already paid off. No sir, वो दूसरे account से pay किया. अरे तो क्या हो गया? ये loan से you will transfer 500 there. Today 500 looks a small amount because you and I are regularly seeing 500. But you think about, suppose this is 100 crores of loan and the transaction cost is 50 lakhs. Then you will be paying off this 50 lakhs. No, so do you think 100 crores is at your disposal? Answer is no. What is at your disposal is 100 crores minus 50 lakhs. Similarly, here at your disposal, the funds available is not 10,000. 10,000 आ गया, that is fine, but 500 जा भी तो चुका है, it has gone already. So here you have a financial liability as a credit balance and you have transaction cost as a debit balance. So financial liability also should be recorded at fair value, but it has to include a transaction cost. And when I say include transaction cost, I will deduct the transaction cost from my financial liability. I will deduct. Yes. So the upfront fees which is there mentioned in here, the upfront fees of 500 is the same as the loan processing fees of 500 mentioned here. And the fact that I have to pay a transaction cost means I'm not having 10,000 at my disposal. I am having 10,000 minus 500 at my disposal. You can take it off like I have taken a borrowing of only 9,500. Are you able to follow? You come out with a debenture issue of say 1,000 crores. Arey, but 1,000 crore mein aapka, you get the full amount. You just have a dream that I need to get a debenture of 1,000 crore. And then you put it out in social media on your own handle and people will come with 1,000 crores. No. There is a huge cost involved. You have to get consultants. If it is listed debentures, you have to give a prospectus. Then you have to take SEBI approval. Then you have to hire underwriters. All the commission, all the professional fees, etc. What are they? They are nothing but transaction costs to get a successful debenture issue. And when you get the debentures, when you get the debenture money in your account, what is the first thing you will do? Consultant हाथ फैला के आपके सामने खड़े रहेंगे. अब तेरे को हमने दे दिया ना loan. Now you pay us our money back. So what do you think? Out of 1000 crores, if the transaction cost is 1 crore, at your disposal, it's only 999 crores. It's never 1000 crores. So therefore, I now come to the next question. If my disposal, if the amount of liability at my disposal reduces because of transaction cost, which it does, will the effective interest rate on the financial liability decrease or will it increase, assuming that the principal amount has to be repaid in any case? You have to repay the principal amount. There is no doubt about that. But because of the financial liabilities transaction cost, transaction cost means what? Transaction cost means processing fees, consultancy charges, basically all expenses. Kabhi you have to give projections to the bank. So projections ke liye you hire some person. You go prepare 5 years projection, 10-year projections, and then you bill the client. All these are what? All these are processing charges. These are processing charges bolo, transaction cost bolo, upfront fees bolo. They are everything the same. So therefore, will my effective interest rate increase? Answer is yes. Answer is yes. See, earlier, if transaction cost was not there, borrow 10,000, repay 10,000. Koi tension nahi, 10% was your loan. But now you are borrowing 10,000. But how much are you getting? Sir, I am getting 9,500. And if I am getting 9,500, I cannot say 10% is my interest on the same span of time, because if I take 10% on the same span of time of, let us say, 5 years, I will not reach 10,000. नहीं पहुंचूंगा मैं 10,000 पे. My effective interest rate is going to increase. It is basically, as you rightly said, Namrata, it is the cost incurred to get the loan. Transaction cost, processing fees, all these kinds of fees which you are going to pay. Consultancy charges, underwriter's commission. It could mean anything. I'm not restricting it to processing. Okay. Debenture issue, you have huge amount of consultants who will be there behind you. Okay. वो एकलौता company से होने वाली चीज नहीं है. Okay. So you will have to do that, and ultimately that is what leads to an increase in EIR. So whenever you see transaction costs in the question, whenever you see transaction costs in a question on financial asset at amortized cost or financial liability at amortized cost, you have to find out effective interest rate, because it will be different from the normal interest rate mentioned in the question. Otherwise, the question will specifically tell you this is your effective interest rate. This is your effective interest rate. Is it okay? Yes. Are you able to follow? Yes. So let us proceed with the question now. Let us proceed with the question. Okay. All right. Issue of borrowings with fixed rate of interest. Now, this is illustration 31. All right. Read the question. Anywhere are you given interest for a similar transaction at market prices is so much, or market price for a similar interest loan is so much, or rate of interest for a loan with similar terms is so much. Are you given? Not say it is not at market terms. Okay. Acha, now let us proceed further. Present value. This is illustration 31. Okay. Illustration 31. Present value of cash inflow. How much it is? Present value of cash inflow is equal to, present value of cash inflow is equal to 10,000 minus 500. 10,000 minus 500. Okay. Just a second, please. Just a minute. All right. Sorry for that. Okay. Okay. There is no electricity since today morning. Okay. All right. Present value of cash inflow is 10,000 minus 500, 9,500. Okay. So this is the net proceeds that is going to get. Okay. Some textbooks call it as net proceeds. Anything is fine. Anything is fine. Okay. Now coming to we have to calculate EIR. So what is EIR? It is based on internal rate of return concept. And what is the internal rate of return concept says? It says that the EIR is that rate of interest which equates the present value of cash inflow to the present value of cash outflow. So therefore, let us calculate the present value of cash outflow. So PV of cash outflow is equal to, can somebody help me with the calculation? My borrowing is 10,000. Coupon rate is 10%, the interest rate. Yes. Upfront fees I have factored in the net proceeds. It is payable by way of a single bulletin payment after 5 years. Okay. So interest is paid at 10% per annum. Interest is charged and paid yearly. So now, can somebody tell me the present value of cash outflow? Very simple. I am the borrower. So for me, the loan taken is an inflow, loan repayment is an outflow. So 10,000 into 10%. This becomes my annual coupon. This becomes my annual coupon that I'm going to pay, multiplied by present value annuity factor 10% for 5 years. You will be doing this task for 5 years. So into 3.7908 into 3.7908 plus 10,000. The principal also you are going to pay. Sir, when am I going to pay the principal? You will pay the principal at the end of the 5th year. At the end of the 5th year. So into 0.6209 into 0.6209. So what does this come to? Well, this comes to how much? This comes to how much? 1,000 into 3.7908. 379. 1 second. It comes to 10,000. It has to come to 10,000. Plus 6209. It has to come to 10,000. This is the annual payment that you are going to make. Okay. But if you take, this is at 10%. I'm calculating the EIR. Okay. The objective is to calculate the EIR. So if I take at 12%, see, you said EIR increases, right? You said that the EIR increases, and therefore we are calculating the effective interest rate. So this is equal to 10,000 into 10% into present value annuity factor 12% 5 years. So this comes to how much? This comes to 3.6048 plus 10,000 into present value factor 12% for the 5th year. So this comes to how much? This comes to 0.5674. So that comes to how much? That comes to 9,279. So is it meeting the criteria in between? See, I have to match it with 9,500. At 10%, it is 10,000. At 12%, it is 9,279. And therefore, can we say that the effective interest rate on this borrowing with a net proceeds of 9,500 falls between 10 to 12%? Answer is yes, it falls between 10 to 12%. So now we will have to proceed and calculate the effective interest rate. So how do I calculate? Interpolation. You have done interpolation, right? So let required rate be X. Let required rate be X. So how do I do that? Well, take up the X minus 10% divided by 12% minus 10%. The 2% gap below and X minus the earliest gap above. Okay, so for X, you want a cash flow equal to 9,500. So 9,500. At 10%, the cash outflow is 10,000. At 12%, the cash outflow is 9,279. And here it is 10,000. So if you do this, you will get X minus 0.1 divided by 0.02 is equal to 500 divided by 721. Minus minus cancel out each other. It will be positive. Therefore, X is equal to 0.10. I shifted that side, plus 500 by 721 into 0.02 is equal to 0.1139. That is 11.39%. 11.39%. Is it more than 10%? Answer is yes. Why? Because of transaction cost. Because of transaction cost. Okay. Are you able to follow? Transaction cost समझ में आता है अपने को now? Are you able to appreciate? Yes. Come on, tell me. Are you able to follow? Yes. You want, you can take your time and calculate. Okay, take your time and calculate. I'm in no hurry to do it. Okay, take your time and calculate. No problem. But this is how the calculations will work. Okay, this is how the calculations are going to work. All right. Okay. Okay. Now, so you will be recording the loan. How is the solution worded? The loan taken will be measured at amortized cost. That is what we have done. Net proceeds of 9,500. And then you will do an amortized table working if you want. Okay. थोड़ा सा rounding off में gap है. I don't think it is a serious issue. Okay. If you want absolute accuracy, take another trial at 11% and then do the movement from 11 to 12%. आपको और ज़्यादा accurate आएगा. Okay. But I don't think it's going to be a major concern because it's okay. I mean, 0.01, 0.02% up and down is really fine. Okay, so that takes care of the transaction. Okay, now this is the transaction. This is all IRR workings. Okay, so we have also done IRR. If you are comfortable, you can follow that. Otherwise, you can use our workings. Okay, all right. Now, see, one thing is what you will have to check. It won't come to 10,000 beta. It won't come to 10,000. Present value at 10%, not coming to 10,000. See, 10,000 into 10% is 1,000 into 37908. So 3790.8 plus 6209. It should come to 10,000. Please check. You cannot take it other than 10,000. It does come to 10,000. Just check once again, Kaushiki. Just check the working. Okay. Must be some number you would have keyed in incorrectly. Okay. Just check. Just check. Just check. Okay. All right. See, the interest which is being charged on amortized in the amortization table, this interest is coming to 5,500 for the entire period. What is this 5,500? This is nothing but 5,000 coupon payments which I am making, and 500 is the transaction costs which I am expensing it out. 500 is the transaction costs which I have expensed out. You can take 11.39% also, wahi aayega. Maybe here the totals may change, here the individual figures may change, but end result is you will end up with a total interest expense of 5,500. If you remember, when we did for financial asset, today only we did finance transaction cost. In there, the transaction cost was reducing the net income. Are yaad karo, the transaction cost of 1372 in today's question, it was reducing the net income by that amount. It was 46,372 in the first question. It became 45,000 in the second question. The total interest recognized. Why 45,000? Because from 46,372, 1,372 transaction cost was deducted, and it is forming a part of the profit and loss account by virtue of reduction in the interest, by virtue of reduction in the interest income recognized. That was an asset. So transaction cost was an expense for me. So it goes ahead in reducing my income. However, in the case of a financial liability, I have finance cost as already appearing as an expense. So transaction cost is going to further add expenses, and therefore it is getting added to my coupon rates, and therefore 5,000 ka kharcha has now become 5,500 for the entire duration of the borrowing. So essentially, when we talk about transaction costs, redemption premiums, etc., ultimately, where do these instruments, where do these features go? Do they sit in the balance sheet? Answer is no, they don't sit in the balance sheet. Ultimately, these instruments, where do they go? They ultimately go and sit in your profit and loss account. They also get amortized over the life of the instrument. They are fully amortized. Okay. You can do this check for any financial instrument that is there. Wherever you have transaction costs, it ultimately ends up getting amortized. Okay. So that takes care of illustration number 31. That takes care of illustration 31. Next, what is illustration 32? Okay. Illustration 32 is a simple question. I want you to try it for homework. Nothing difficult. Same interpolation is there. Calculate it and do the working. Okay. Nothing difficult. You should be in a position to do question number illustration. Wait, not this one. Sorry, my mistake. Not this. Let me check. It's actually illustration 20. Illustration 20, 12.47. Okay. This is for homework. Okay. Please read this, solve this. You should be in a position to get it correctly. Okay. Illustration 20 is for homework. Okay. All right. Now, okay. All right. Fine. Okay. So now what exactly is left for me to train you? Because doing all the questions, fine. question. I need you guys to try out May 22 examination question 6B. Okay, May 2022 exam question 6B. Try to solve that question. In that question, what happens is there are quarterly payments of principal also. So it is making the transaction a little more complicated. Okay, it's not affecting my fair valuation, not affecting my initial recognition. Only the repayment that is there, it is happening at a quarterly basis. So I want you guys to try that examination question, May 2022, question number 6B. Okay, just try that question for your own practice. Okay, please ensure that you do that. Next one is 37. Okay. All right. So this takes care of amortized cost. Now, there are two things which are left. One is a prepayment option. One is a prepayment option, which is fine, which is doable. Okay. But more important than that, see, I have to go based on time also. Okay, I have to go based on time also. So the other factors which I can look for is accounting for equity. See, I have done accounting for financial assets right now. I have done accounting for financial liabilities with you. And I have also done with you, what is left from my side is accounting for equity. So we quickly take the theory on accounting for equity. I have not done prepayment of financial liabilities. Okay, that is still pending from my side. I don't think it has come in the exam, but I will briefly touch upon the issues because I want to move as quick as possible to convertible financial instruments. And then we have to do a little bit on derivative accounting also. So considering that, I will be discussing the other parts in theoretical terms and maybe run you through the questions, couple of them, so that you can at least know from where you have to start to do the calculations. Okay, so now coming to equity accounting, initial transactions for equity, that also will happen at fair value. Okay, so accounting for equity, Acha, initially at fair value. No doubt about this. So financial asset, initial recognition, fair value plus transaction cost, except FVTPL, where transaction cost is taken to the P&L. Financial liabilities, amortized cost method, we have seen fair value at initial recognition minus the transaction cost. And if it is FVTPL, anyways, it is fair value. Okay, anyways, it is fair value. Okay, and then the last one is equity. Equity is also fair value. Financial liability, fair value through P&L, it covers all special instruments like derivatives. It covers special instruments like financial guarantees, contingent consideration. You have 6 instruments there. So financial liabilities, FVTPL accounting, we will be doing it along with derivatives. Okay, so there you can understand the fair value accounting. Basically, fair value through P&L accounting is quite I showed you how we did for equity. So all the fair value at each reporting date you measure, and the movement in the fair values is taken to the profit and loss. It is, the crux is this, but there are concepts like what is derivatives, how do we do split accounting for derivatives, whether separation is required from the host contract. All these things are going to be discussed when we do derivatives, and there you have liabilities accounting as well. So I would prefer to do a FVTPL liability accounting along with derivatives so that it covers a lot of what you can say, other concepts also. Okay, so coming to transaction cost, for amortized cost financial assets, add. For FVOCI assets, add. For FVTPL financial assets, take it to P&L, do not add. Whereas for financial liabilities at amortized cost, it is fair value less transaction cost. Look at the question we just now did. 500 is transaction cost and I have subtracted. Why did I subtract? Because loan has a credit balance, processing charges has a debit balance, and that is why you will have to deduct it. That is why you will have to deduct it. Is it okay? So coming to accounting for equity, initially you will be recording it at fair value. After that, what do you think? After that, what do you think? Do we do a remeasurement or do we just keep quiet? Haath pe haath rakh ke baithenge hum. What do you think? Will we remeasure equity or will we just keep it at the initial value? Value at initial recognition. Value at initial recognition. What do you think? Remeasure. Okay. No remeasurement. Acha. You guys have attended Ind AS 102 class? Have you attended Ind AS 102? I ask only my sessions because मेरे को सिर्फ मेरा session पता है. Okay. I don't know how many of you attended. Did you attend Ind AS 102 with me? In Ind AS 102, we had discussed about SPP reserve, share-based payment reserve. Yes. And in share-based payment reserve, we had mentioned specifically that in share-based payment reserve, we have mentioned specifically that we cannot remeasure own equity. Let me take an example for you so that we will never forget it for life. Take a company like TCS. TCS equity shares are probably at a face value of 1 rupee or 2 rupees per share. But TCS market price is about 2,400 to 2,500. Now, when you talk about own equity, in TCS's balance sheet, equity share capital comes under equity. Yes. Equity has a fair value because it is traded on National Stock Exchange, Bombay Stock Exchange. Those are proper markets. So the fair value of that share, is 2,400. But sir, my books mein the equity is only 2 rupees. So if you talk about remeasurement, we have to measure own equity. Then open TCS's balance sheet. Do you see that equity of 2 rupees, equity capital of 2 rupees, is it being remeasured to 2,400? Do you think that 2,398 rupees is appearing as increase in value of equity? What do you think? Is it appearing? Answer is no, it will never appear. Because, why? Because, okay, acha. So now we came to know the problem. Now we came to know the solution also to that. But we want to know the reasoning behind that solution. Why don't we remeasure own equity? It is against our principles. It is against accounting. What goes in your profit and loss? Sir, profit and loss is the sum total of my incomes, expenses, basically the result of my operations during the year. So in the result of your operations, it is purely the output of what you have performed during a particular financial year. If you start bringing market movements on your share price in your profit and loss account, is the P&L giving a fair view of your operations, or is the P&L getting colored on account of market movements? Is the P&L getting colored on account of market movements on your share price? If you start bringing the market values on your own equity to your P&L, your P&L starts getting colored. Let us take another case. You have that famous stock rout which happened with one of the famous companies of India on account of some allegations which were done. Imagine the drop in the values. If those drops had to be reflected in the P&L, where would the balance sheet stand? Where would the profit and loss stand? $100 billion erosion in shareholders' wealth. Oh, bechara, once he was in the top 10, he has slipped to top, he's not even in the top 20, I suppose, right now. So, do you show that movement in your P&L? You never show that movement in your P&L. Your P&L is the sum total of your operations only. And now we have also introduced another comprehensive section, other comprehensive income section, where items which are typically where you feel that market interference is there, we should ultimately separate it out to other comprehensive income. So therefore, will you show remeasurements of own equity? Answer is no. Answer is no. आप नहीं दिखाते हो. Okay. No subsequent remeasurement. No subsequent remeasurement. Okay. No subsequent remeasurement. Writing is becoming hard. No subsequent remeasurement. Okay. It continues at the value at which you recognized initially. At the most, you can move it from one component of equity to another. SBP reserve आपको याद होगा, when the options lapsed, I used to transfer SBP reserve account debit to retained earnings. That is permitted because it is not changing the own equity. It is moving only from one component to the other. When shares were exercised, SBP reserve would ultimately move to equity share capital or to securities premium, from one component of equity to another. When shares were exercised in equity settled options with a cash settling options, equity settled instruments with cash settled options, then what you used to do? If they opted for cash, the SBP reserve moved to retained earnings. If they opted for shares, SBP reserve would be taken to equity as well as the securities premium. And therefore, accounting for equity is always initially at fair value and thereafter no remeasurement. Thereafter no remeasurement. But do I have issue expenses? Do I have issue expenses? Answer is yes. I have lot of issue expenses. So if I have lot of issue expenses, then the question that you have to ask yourself is the issue for fresh shares or for existing shares? Fresh shares means IPO, existing shares means OFS, offer for sale. Okay, offer for sale, वो एक बड़ा सा कंपनी आया था ना हमारे इंडिया में, LIC. LIC was an offer for share. Okay, offer for sale means what? Offer for sale means capital of the company does not increase. Government reduced its stakeholding in LIC. That's it. Government reduced the stakeholding in LIC, and made it open to public. But did LIC get any money on account of the offer for sale? Answer is no. Who got the money? Government got the money. Government got the money because it reduced its share. It reduced its share. It's not a further public offer. A further public offer typically increases the share capital. But in an offer for sale, capital is not increasing. See, understand. I had LIC, I have government on one hand and public on the other hand. What is IPO? Everybody knows. What is further public offer is IPO ke baad when you come out with another fresh issue, it increases the share capital of the company. Usko hum log bolte further public offer. But in the case of LIC, government transferred its holdings to the public. That's it. Public gave the money to the government. Did LIC issue fresh shares? Not even one share was issued. Okay. Not even one share was issued. This was just a change in the stake of the government. It transfers some 3 to 5%, I suppose, to the public, and public are now holding the shares of LIC to the extent of 3 to 5%. इसको हम लोग बोलते हैं offer for sale. So you have to ask the question, is it the issue for fresh shares, which includes IPO, FPO, etc., or is it for existing shares? So first option, fresh issue. Fresh issue. Then what you will do, issue expenses. Issue expenses is taken directly to reserves. Is taken directly to reserves. Okay. It is not going to go in the P&L because these expenses are for getting additional capital. These expenses are for getting additional capital, and therefore they are an owner to owner transaction. They are an owner to owner transaction, and that is why you are going to take it to the reserves. You are not going to record it in the P&L. But if it is for existing shares, what am I going to do? Sir, for existing shares, we will be taking it to the P&L. Issue expenses recognized in profit and loss. Issue expenses are recognized in profit and loss. So this is the accounting for equity instruments. This is the accounting for equity instruments. All right. So therefore, if I have to summarize your transaction costs, we have done a lot of questions now. So if I have to summarize your transaction costs, I will need your help. One is financial asset. Financial asset. You can note down this chart. It can help you, hopefully. Okay. So financial asset. बहुत बड़ा हो गया. One is at FVTPL and the other is others. So what does this include? FVOCI as well as amortized cost. Okay. So tell me, if the financial asset is measured at FVTPL, where will the transaction cost go? Where will the transaction cost go? See, you will have to give me the answers. I know it has been a tiring day for me also, but let us quickly get over with this. Yes, tell me. Come on. For financial assets at FVTPL, where does the cost go? Transaction cost. This will go straight away to the P&L. Absolutely right. This will go to the P&L. Correct. Janvi, Namrata, Kaushiki, all of you right. Acha, what about others? FVOCI or amortized cost. Okay, what am I going to do? I will add to financial asset. Add to financial asset. Transaction costs in case of financial liabilities measured at FVTPL, take it to the P&L. Take it to the P&L. Whereas in case of others, and this students make a mistake, deduct from financial liabilities. See, today you can remember it. But what happens with transaction cost is, you have seen in property, plant and equipment, you have seen in intangibles, you have seen in investment properties, and you have seen in financial assets. Everywhere transaction cost getting added. That is because assets are debit balance, transaction cost debit balance, added. But in the case of liabilities, liability is credit and transaction cost is debit. That is why it should get deducted. But in the course of your remembering, you say that transaction cost har jagah pe add ho jata hai. And if you do that, your EIR will go wrong. Your whole accounting only will go wrong because of that. Okay. So therefore, please do not go for addition. Be a little alert. When you see a question, if you know the question, if you know it very well, then also pause. In excitement, many times we do a lot of mistakes. And if you don't know the question, then also pause. Because getting panicky in your examination will affect the other questions which you do not know. Will affect the other questions which you do not know. Okay. All right. Fresh issue. What are you going to do? What are you going to do? 1 second. Reduce from reserves or other equity. Whereas for existing shares, expense in P&L. Expense in P&L. Okay. So this is what is your summary for transaction cost. This is what is your summary for transaction costs. Okay. So with that, do we still have little time? Can I take another 10 minutes? Then we can complete reclassification also. Then I can leave you with questions on reclassification, so that in the next class I will do purely convertibles question solving. Okay. So I will quickly complete the theory on reclassifications. Yes, I'll quickly complete the theory on reclassifications. So then that should be able to kind of sort out the issues. Okay. See, when I talk about reclassification, I essentially mean from if I talk about financial asset, it is from amortized cost to FVTPL, or FVTPL to FVOCI, or FVOCI to amortized cost, वगैरह वगैरह. Okay, it is not between financial asset to financial liability. वो कैसे हो सकता है? Nature of asset and liability cannot change, na? So there will be some reclassifications which are possible. We will see what is that. It's pure logic. Okay, it's pure logic. I don't need huge thinking. Okay, you just need to think and answer. You just need to think and answer. So reclassification. Within financial assets, financial liabilities. Acha, equity cannot be reclassified. Why, sir? Can you tell me the reason? Can you tell me the reason equity cannot be reclassified? Look at the chart when I told you accounting for financial assets, financial liabilities, etc. Can equity be reclassified? Arey hai hi nahi option. Equity has only one accounting, fair value on initial measurement. That's it. And thereafter no remeasurement. That's it. You don't have FVOCI, FVTPL, etc., etc. What is there? It is not there for equity. So equity, I told you it's common logic. No reclassification. No reclassification because only one accounting method is there. Okay. No reclassification as no category types exist. Only one accounting is there. Okay. So equity ho gaya. Financial assets. Can I reclassify financial assets? Acha, how were they classified in the first place? I used to check SPPI test. If SPPI test is not met, it goes directly into FVTPL. If SPPI test is met, we look at the business model. If the business model is held to collect, amortize cost. If it is held to collect and sell, it is FVOCI, which can be reclassed. Equity is always, investment in equity is always at fair value. You can take an irrevocable choice of FVOCI, which is non-reclassifiable. Okay, which is non-reclassifiable. Now, so tell me, financial assets, when can you do a reclassification? You can do a reclassification only when the business model changes. Possible only when business model changes. Possible only when business model changes, because business model change only can shift from amortized cost to FVOCI, FVOCI to amortized cost. Equity can shift from FVTPL to FVOCI, but not vice versa. FVOCI to FVTPL is not permitted. Okay, FVOCI to FVTPL is not permitted. Okay, because that is a one-time irrevocable option. तो आप उसको shift नहीं कर सकते. Okay, so that is how you do the accounting. So now this can happen only when business model changes, and change in business model is extremely rare. The standard recognizes that आप business model घड़ी घड़ी change नहीं कर सकते. Okay. Third one, financial liabilities. Financial liabilities do not have contractual cash flows test, do not have SPPI test, do not have business model test. It is just having 6 instruments at FVTPL, remaining all at amortized cost. So 6 instruments, that is derivatives, you have certain contingent considerations, you have guarantees. 6 instruments are there, we'll come to that. But apart from these 6 instruments, everything else is amortized cost. So tell me, in the case of financial liabilities, is reclassification permitted? Answer is no, because it is factual. जब मेरा asset is a contingent consideration under Ind AS 103, it cannot be anything else, and therefore वो बैठेगा सिर्फ FVTPL में. If I have a bank borrowing, it is not any of those 6 special categories, and any of those 6 special categories nahi hai. That means the bank borrowing can never become that in the future. It is a factual item, and therefore financial liabilities classification also is never permitted. Okay, financial liability classification also can never happen. So reclassification. Okay, reclassification is not permitted because classification of financial liabilities is factual based on nature of instruments. Reclassification is not permitted because classification of financial liabilities is factual based on the nature of instruments, which cannot change. Obviously, now if it is, for example, if I make a furniture, I cannot say it is a machinery. वो furniture hai. Okay, so likewise, those instruments cannot become other instruments. Other instruments cannot become these 6 instruments, and that is why reclassification is never possible for financial liabilities. So basically, आपका reclassification कब होगा? Only for financial assets. That too when the business model changes. Okay, so change in business model is extremely rare. You sell some financial assets does not mean the model changes from held to collect to held to collect and sell. Not necessary. Okay, you have to look at how the overall response is. On a business level, on a generic level, how you are operating. Okay. See, financial liability. Okay. 1 second, just a minute. I will tell those items because every time I'm using six items, it's not looking nice. Okay. Okay. You can just write down classification of financial liabilities. This goes under two headings: FVTPL and amortized cost. Okay, so FVTPL, you have six items. First one, derivatives. First one is derivatives. Okay. Unless hedge accounting applies. Unless hedge accounting applies. Second one, held for trading liabilities. Held for trading liabilities. Example, securities short sold. ये तो सबको पता है किसने किया था ये कांड. Okay, so securities short sold. Okay, next, liabilities designated at FVTPL to correct an accounting mismatch. To correct an accounting mismatch. Fourth, financial guarantees. Fifth, contingent consideration. And sixth one is continuing involvement approach. Okay, we'll see what this is. Part of derecognition. Okay, amortized cost, all other liabilities. All other liabilities. Apart from these six, if there is anything else, it goes under amortized cost. Okay. No CCFC, SPPI, business model test for financial liabilities. No CCFC, SPPI business model test for financial liabilities. Okay, so these are the six items. So basically the nature of this, okay, classification of financial liabilities goes as per the nature. An item which is a derivative is a derivative. It cannot be all other liabilities. A bank loan is an other liability. You cannot say it is a financial guarantee. Arey hai hi nahi wo. Yes. So can I reclassify my financial liabilities? Answer is no. वो इंस्ट्रूमेंट के नेचर के हिसाब से it has fitted. It's not judgmental. My point of saying is it's not judgmental. It's factual. Okay. You can do a reclass only when something is subjective. If something is objective, you just tick the boxes. It falls under the six categories FVTPL. It does not fall under the six categories. It is amortized cost. You cannot say today it is not falling under the six, tomorrow it can fall. Hari, how can it fall under that? वो कोई nature change होने वाली चीज थोड़े ना है. Okay, you cannot say that आज नहीं है but कल हो सकता है. So therefore, reclassification of financial liabilities is not permitted. Okay, it is purely based on nature. Okay, so therefore reclass of financial liabilities can never happen. Okay, so this takes care of financial liabilities. And now we come to financial assets. Okay, have you guys noted this down? Have you guys noted this? Namrata, I hope you understood now reclass of financial liabilities. Okay, all right. So that is done. Classification of financial liabilities. Please do one thing, if possible, tomorrow you don't have a class. So please look up at the questions that we can do by ourselves and try to solve them. There are many questions which you cannot do till now, but that is okay. All right, we'll be covering that. But the other ones, please see if you can try and solve it. Okay. All right. Now coming to reclass. It can happen only when business model changes. Which one? Financial asset reclassification. And change in business model is extremely rare. Change in business model is extremely rare. So gain or loss on reclassification. Okay. But this is the last part of today. Most of it is logical. You can think for little time. Okay. Amortized cost to FVOCI. Change in business model, held to collect, say it became held to collect and sell. So therefore, whatever was appearing at amortized cost will now appear at fair value. Fair value will be different, amortized cost will be different. And if fair value and amortized cost are different, there will be some gain or loss on fair value. So where will I recognize? Naam mein likha hai na, other comprehensive income. So therefore, the gain or loss on reclassification will be taken to other comprehensive income. Okay, we will take it to other comprehensive income. Amortized cost. Amortized cost to FVTPL. Okay, amortized cost to FVTPL. If we go for this option, the gain or loss will be recorded in the profit and loss. The gain or loss will go under P&L. Okay, so ये हो गया मेरा amortized cost to FVOCI to FVTPL. Third one, FVTPL to amortized cost. To amortized cost. I bring it to the amortized cost. Okay, so therefore any gain or loss, we take it to the P&L. I'll just finish this. The class is ending, Viraj. Just it's coming to a close. Okay, then nothing else is there. Even I am sitting as it is. Okay, we'll just complete this. FVTPL to FVOCI. The gain up to the date of classification, reclassification will be in the P&L, and thereafter it will shift to other comprehensive income. So up to the date of reclass, the gain or loss will be in the P&L. Okay. Fifth one, FVOCI debt to amortized cost. FVOCI debt to amortized cost. This balance would remain in the fair value reserve. So balance in fair value reserve adjusted against carrying amount of financial asset. I will explain the reasoning in the next class. Okay. FVOCI debt to FVTPL, balance in fair value reserve, transfer to P&L. 7. FVOCI equity. This is irrevocable choice and therefore cannot be reclassified. Cannot be reclassified. One time irrevocable choice taken. Okay. So this is the brief summary on reclassification. Some are very obvious. The others are not so obvious. So the not so obvious ones, we will see it in our class on Tuesday, and then we shall proceed with convertibles accounting. Okay. So that should take care of our syllabus. I don't know. I'm getting very scared. Syllabus is huge, and as far as I know, I have tried to give the best to you in the last 5 to 6 days. I hope that there has been a significant value addition to what you have. Okay, there has been a significant value addition in terms of your understanding, in terms of your knowledge. Okay, and I just hope that I can continue to do that. Okay. Thank you, everyone. And thank you for a patient hearing, a patient cooperation. It was amazing to be with you for 5 hours. Okay. I had multiple reasons to be with you for 5 hours. Okay. One is there is nobody at home. So I get to be with my students for half a day. That is the biggest perk I take from today. The second one is other days I am pressed for time. Today there is no pressure of time. So that is the reason I could contribute. And third one is I wanted to do some questions. Talking theory was a big this thing. So today I could finally solve some questions. And fourth one is of course, it's amazing always to have interactions with you guys. So revise whatever is done. Look at the questions, open the past RTPs and try to see whatever questions you can solve. Okay. So with that, we conclude our marathon session for today, and see you guys again on Tuesday. Tuesday, be ready with your calculators and pens. We will be solving questions on convertibles. Okay. Thank you, everyone. Thank you. Namaste. Thank you. Okay.